it's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risk.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, in the green for the year, the S&P 500 wiping out losses since the start of the war as the White House is playing up the prospect of further peace talks, and crude is coming off its fourth straight day, closing below triple digits. WTI trending close to 96 this morning.
This is a FOMO market right now. Everyone doesn't want to miss out on potential gains, as Bank of America strategists put it this morning. Strong rallies suggest that the upside remains the greater concern. This is in stocks. The downside is in oil prices. As you see right now, poly-market odds of the conflict ending this month are 75%. That is the highest level going back since the start of this conflict. People are ready to just move on.
The White House playing up talks about talks. Let's get to the latest reporting from Bloomberg. The US and Iran in discussions about holding another round of face-to-face negotiations for a longer-term ceasefire.
And it could be as soon as this weekend, according to Reuters. And one individual speaking to Reuters said no firm date has been set, with the delegations keeping Friday through Sunday open. So another weekend where everyone will be working. But to Lisa's point, it's not just FOMO. The market is really starting to price in either there's going to be an off-ramp of peace and a cessation of hostilities for good, or the United States is winning right now. That is how the market is looking at this conflict.
I don't think the market's looking at anything. This market's moved on. Based on the price action of the past few weeks, this market has moved on. Bank earnings later on this morning will move on. JPMorgan later this hour, later this morning, Wells Fargo and Citigroup.
And it's fascinating because yesterday Goldman Sachs disappointed with one aspect of their earnings, the fixed income currencies commodities trading. And that sent the shares lower by almost 4%. That said, all the other financials were actually up on the day and the best performing of the day. So people looked at this and they said, this is a Goldman Sachs issue. This is an expectations issue. This is not a banking issue. And it's really something where the bar is still very high for the other players.
Company story of the morning is not in the financials. Let's talk about the airlines. Check it out. American Airlines and United. Scott Kirby of United, according to our sources here at Bloomberg, approaching American about a tie-up. Just think about that. Sprint and JetBlue couldn't get it done. And we're talking about American and United?
Well, so antitrust regulators might be more amenable to tie-ups, but probably not this one. That said, this is fascinating on a number of levels. First of all, Scott Kirby, the CEO of United, used to be the president of American Airlines. He knows this airline pretty well. Number two, there is going to be a period of distress. This is what a lot of different airline executives have talked about. If oil prices remain high, who are the winners going to be, and how much can you ultimately see some tie-ups get explored in this market?
Obviously, the regulatory environment is more amenable during the Trump administration, but this kind of tie-up is just potentially too big, especially with this administration ahead of the midterm elections is trying to talk about affordability. Not only are they thinking about this, Reuters said Scott Kirby approached President Trump directly at the end of February when he was there for a meeting to talk about Dulles Airport. He said, I might make a play for American. I'm sure he pitched it in a way that Trump said, I love a big deal. Maybe this can happen. But I'm not sure if the DOJ or the Department of Transportation is going to greenlight this.
We'll have more on this story later this hour. American in the pre-market higher by some 5%. Coming up this hour, we'll catch up with Brian Levitt of Invesco, with stocks erasing the year's losses. We'll speak to the French Minister for the Economy and Finance, Roth, as Europe faces an energy shock. And Cassidy of RBC reacting to the latest big bank earnings. JPMorgan later this hour. We begin this hour with our top story. The US and Iran weighing another round of peace talks as the Strait of Hormuz blockade enters day two. Bloomberg's Jemana Baseshi joins us now from Dubai. Jemana, welcome back to the programme. Just how is that blockade holding up so far this morning?
Yeah, well, I will say, John, actually, it's become a bit of a side story this morning insofar as the evening was rather uneventful. So the blockade went into effect at around 6 p.m. regional time, around 5 p.m. in Iran. And what we saw overnight was an attempt from several ships to get through the straits. And there's one that we've been monitoring throughout the course of the morning. This is a U.S. sanctioned vessel that has links to China that has been making its way through the Strait of Hormuz. We understand now that it's passed through the strait and is on its way to the Gulf of Oman without any incidents. So, this is perhaps the first example of a vessel or ship that's trying to make it through the strait under this new naval blockade introduced by the U.S. But I should say it's unclear whether it stopped at any Iranian ports, so not a real test per se. But I think the real story this morning is that there have been numerous reports overnight suggesting that we may be in for another round of discussions. And these are mediated discussions, of course, between U.S. and Iran. Reuters reporting that it could happen in Islamabad towards the end of this week. And remember, you have to go back to what President Trump said over the weekend. He did actually describe the talks as having gone well. There are a few outstanding points. He says the nuclear file is still going to be a focus. And again, other outlets reporting overnight, New York Times suggesting that there's still ongoing disagreement on the extent of enrichment that the U.S. are willing to allow, whether it's low enrichment or no enrichment. The Iranians are saying that they want to push for a 5-year timeline on the suspension. The U.S. want to see a further timeline of 20 years. Whether the two can actually bridge the gap between them, is a big question before we go into this next round of potential discussions, yet to be confirmed by both sides. But I will say that as far as the ceasefire is concerned, it is still holding up. And there have been multiple diplomatic channels being worked over the last 24 hours. The Iranian foreign minister had a call with the Qatari PM. He also had a call with the Saudi foreign minister as well, clearly moving in the right direction from the Iran Gulf perspective. And then let's not forget that the ceasefire, in theory, ends in a week's time. So if they want to get something done, that it would probably have to happen in the next couple of days, yet to be confirmed, though, by both sides.
Jemana, good to see you. Good to catch up, as always. Bloomberg's Jemana Basachi leading our coverage out of the region this morning. Brent at 98, WTI at 96. To Jemana's point, the talks are ongoing. And so long as the talks are ongoing and the back end of the futures curve is behaving, this market seems to be comfortable with deploying just a little bit more capital and adding to the rally we've seen so far.
Yeah, it seems like a rush in, frankly. And a lot of people are talking about how the pain trade is to the upside, because ultimately that's what it's always been. And they want to forget about this. And they're getting a sign. Maybe they can start to do that.
Here's the view on Wall Street so far this morning. Brian Levitt of Invesco writing, if the futures market is correct and oil prices are around 80 per barrel in 12 months' time, that outcome would likely not be a deal breaker for the US economy. Brian joins us now for more. Brian, good morning.
Hey, good morning.
You are our FOMO guy. We always introduce you as our FOMO guy. If you're sitting this out, what are you missing out on?
I think the specter of April 9th, 2025 looms large. I think a lot of investors are contemplating it, where the administration backed off from its worst impulses on tariffs, and you had one of the best up days in the market you've had in years. And so this whole time, investors have been very cautious about missing this. And, if we were to have said on February 27th at the close of the market that this conflict was going to begin, I don't think most people would have thought that the worst you'd see is 10% down in the Dow. Dollar barely moved, credit spreads barely moved, 5-year inflation expectations up a bit, but not a ton. Market's going to price out the rate cuts, but without much incidence. So it's been a market that obviously has been a little volatile around events. It's always volatile around policy uncertainty, but it's a market that's just wanting to look past it, at least to this point.
We've had a total reset. We've wiped out the losses since the war started. We're positive on the year so far. Where are you comfortable, just thinking about the risk reward at the moment, given the reset we've seen, where are you comfortable being within the equity market?
So I'll take two questions there. One, are stocks going to continue to outperform bonds? We think so. You would be in a much worse environment with regards to spreads, inflation expectations, policy tightening, if we didn't think stocks were going to outperform bonds. Now, in terms of market leadership, that's a tough one, because coming into the year, all the leading indicators globally were in expansion, and that's small cap, that's emerging markets, that's value. And they, for obvious reasons, have given you a little bit of a slowdown signal here because of $4 gallon gasoline. So that gets you back into mega cap and quality. So which one is it? That's a very big challenge over the short term, right? Because we just don't know the duration of this. So I hate to use the word diversified, but I'd say, risk back to neutral, where you want to make sure that you have some higher quality mega cap in the portfolio, but also diversified into things like emerging markets that are likely to outperform as this improves.
So you're not alone. BlackRock also yesterday, Jean Bovin was saying that he also liked emerging markets with the assumption that this conflict ended. It's funny. It feels like taking a driver's ed class where they tell you everything that you can go wrong and all the kids just ignore it because they try to just get past it. Just get me in the car. I want to go where I want to go. You hear Fatih Birol saying that prices are high, but they're not reflecting the severity of the problem. I agree there is a disconnect. We will see a convergence. At what point do you have to hedge against the chance that this is not over?
Yeah, so what I've been telling investors is that, look, we're not military strategists the same way we weren't molecular biologists in 2020, although we certainly tried to play them on television. So I watch what the market is telling me. And, look, when this started, people said, well, if this goes on more than a couple of weeks, we're in trouble. Well, it's now 6 weeks. Well, if this goes on 3 months, we're in trouble, right? So look at what the market is telling us. And, to come back to the same things, you're just not seeing breaks in the credit market. You're not seeing the bond market in disarray. So I wouldn't be thinking about it necessarily from the duration of it. I would be thinking about it from what the market is telling us. And the market is telling us that we're likely to see this come to a conclusion sooner rather than later.
A number of strategists have said that the market is also suggesting that tech needs to really take the leadership again, because that is going to be the area, to John's point earlier, that it might be most immune to inflationary pressures that are more likely, frankly, to $100 a barrel than $130 or $140 a barrel. So do you agree with that type of positioning versus earlier this year?
Yeah, that's what a slowdown would tell you right now. That's what $4 a gallon gasoline will tell you. No rate cuts. So you're back to an environment where you're looking for growth in what's likely to be a slower growth world. But that can change fairly quickly. If you look at the backwardation in the oil market and you're back around $75 a barrel, if the Federal Reserve comes back into play, you could see back that rotation to the broader market. So, that's a little bit of the frustrating part of it. And, we said coming into the year, this is the broadening market. This is the great global expansion. I remember talking to the team on Friday, February 27th, and said, don't talk to a pitcher during a no-hitter. This is great. And then we got the curveball that is the Iran war. So, yeah.
Brian, how much of this, though, is Trump conditioning for the financial markets? I was thinking yesterday at the close, would we be here if it was a different president, if we had a different commander-in-chief? That's
an excellent point, and he's done a very good job of getting the markets calmed at certain times and anticipating a better outcome than what we might have otherwise feared. So we'll see. I mean, it's not clear that we would have been in this under all administrations, but it's also, not clear if we'd be willing to, walk away with a negotiated deal as quickly. So you have both sides of that. I think Trump, on certain days, has done a very good job with the power of the mic, the bully pulpit, being able to suggest that something's in the works when it's not necessarily. There's still that risk of that, no doubt. But I would still come back to the fundamentals of the market suggesting corporate America's in reasonably good shape, the global economy's in reasonably good shape.
It's kept you anchored, and you've been right to stay constructive around all of this. Brian, it's good to see you, as always. Thank you, sir. Brian Levitt there of Invesco. Bramo talked about the Bank of America Fund Manager Survey, some highlights of that. Expectations for growth, down the most since March 2022. Expectations for inflation, the highest since May 2021. The title of the piece this morning, bearish and long.
Yeah, well, I mean, this
is Doesn't that tell you about how investors have thought about the last month? Bearish and long?
They don't feel good, but they keep buying, kind of like consumers. They don't feel very good, but they keep on going out and buying clothes and going out to restaurants. The other thing is this Bank of America Fund Manager Survey was taken over a period when the conflict was probably more severe, number one. And number two, it is a fantastic contrarian indicator. So if you want to get long, here's your confidence.
Get long bonds as well. Check out this headline that crossed the Bloomberg terminal just moments ago. The UK receiving a record £148 billion of investor bids for a 10-year debt sale. That 10-year yield moved almost 70 basis points through the month of March and got to the highest level since 2008, and a buying's come in. You saw a similar move in Japan just yesterday. 20-year debt sale, the strongest demand since 2019. So yields have backed up. Bob Michael at JPMorgan talked about it multiple times over the last month. Investors were ready to step in. They're stepping in.
I thought that the Japanese bond sale was really notable, given the fact that you saw the greatest amount of demand versus the supply being sold since 2019. These yields are attractive to people. People want income, and they're getting it. And I think the UK really highlights that.
The latest headlines on the bond market for you this morning. Let's get you some top stories elsewhere with your Bloomberg brief. Yahira's back with us for more. Hey, Yahira.
Good morning, John. The U.S. and Iran are considering a second round of talks before their 2-week ceasefire ends next week. The New York Times reporting that during the talks over the weekend, the U.S. proposed a 20-year suspension of all nuclear activity, while Iran renewed a suggestion for a halt of up to 5 years. The Chinese president making his first remarks on the Iran war, Xi Jinping describing the international order as crumbling into disarray and vowing to play a constructive role in the Middle East. And United Airlines CEO Scott Kirby is considering a merger with rival American Airlines. Sources telling us here at Bloomberg, Kirby has pitched the idea to senior government officials. A merger would create the largest airline in the world. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. More from Yahara later this hour. Up next on the program, working towards a deal.
We've been called this morning by the right people, the appropriate people, and they want to work a deal. There's no fighting. Right now we have a blockade. So now Iran is doing absolutely no business.
Up next, we'll catch up with the former Deputy National Security Advisor, Victoria Coates, live from New York City this morning. Good morning. Busy morning of bank earnings coming up. Later this hour, we'll hear from JPMorgan. Then in the next hour, you'll hear from Wells Fargo. Following that, we'll hear from Citigroup. Three big names reporting throughout this morning. Tomorrow, Bank of America and Morgan Stanley. In the equity market, your scores are shaping up as follows. Equity futures pushing higher by 0.2% on the S&P 500. Under surveillance this morning, working towards a deal.
We've been called this morning by the right people, the appropriate people, and they want to work a deal. They would like to work a deal. There's no fighting. Right now we have a blockade. They're doing no business. I didn't like seeing boats come out if they were doing business with Iran, but if they weren't, no boats came out. So now Iran is doing absolutely no business, and we're going to keep it that way very easily.
So here's the latest this morning. The US and Iran weighing another round of peace talks before the two-week ceasefire expires next week as the US blockade of the Strait of Hormuz enters day two. Bloomberg's Tyler Kendall has the latest and joins us for more. Good morning, Tyler.
Hey, John. Good morning. Well, diplomacy is still very much on the table as people familiar with the matter tell us that the goal is to hold another round of face-to-face negotiations ahead of next week's ceasefire deadline, because President Trump went on in those remarks to say that the timetable in Iran has not changed. Now, the White House maintains that this weekend's past negotiations did not yield results because of Iran's nuclear ambitions, though senior administration officials have repeatedly said they think that that is an issue that can be breached. And that comes on the heels of multiple reports yesterday that the U.S. had proposed that Iran accept a 20-year moratorium on its uranium enrichment during the talks in Pakistan. That would mark a shift from previous U.S. demands regarding a potential permanent ban on the program. And the New York Times had a little more detailed reporting saying that Iran had proposed a 5-year suspension. That's giving us a little bit of insight into how the dialogue went this weekend. And even with the prospect of further dialogue to come, of course, there is still that risk of escalation on the table. President Trump yesterday threatened to eliminate any Iranian attack boats that come near the U.S. blockade, and new overnight Saudi Arabia is urging the U.S. to end the blockade altogether amid concerns that regional ports could be threatened. Now, John, President Trump also said yesterday that today we may get further details on which countries have reached out to the U.S. to help with the blockade, but he didn't provide any further information other than that.
Tyler Kendall with the latest. Tyler, we'll catch up with you in the next hour. Let's build on this conversation with the former Deputy National Security Advisor, Victoria Coates, writes the following. Closing the strait will remove Iran's last economic lifeline, and they are not going to be able to tolerate that for very long. Victoria joins us now for more. Victoria, welcome back. The Iranian government is very, very good at stretching out negotiations, extend and pretend, extend and pretend. Is there any reason to believe they're willing to give up or will be willing to give up their nuclear ambitions?
Well, good morning, John. Good to be with you. That's the big question here. And yes, as President Trump frequently says, Iran has never won a war and they've never lost in a negotiation. So you do always have to watch that. Their long game, what they'd like to do is stretch this out for a couple of years, at least through November of this year. Their hope is that the Republicans will lose the midterms, the administration will be distracted by a hostile Congress, and then eventually a Democrat will get elected in 2028, and that will be, sort of their lifeline. But I don't think they can survive this blockade. Their internet has been essentially shut down for 1,800 hours. Their stock market's been closed since early March. Their commodities market has been closed for on the same time frame. So if you shut off their ability to export oil on top of all that, you're facing a really, really dire economic situation inside Iran that I don't think is fully understood at this point.
When it comes to the blockade, why is the U.S. willing to have the blockade on Iran, but 3 weeks ago lift sanctions on their crude that was at sea?
Well, I think this is a real shift of approach. And the idea is to break the paradigm, break this historic leverage over the Strait of Hormuz that Iran has exploited at various times to essentially hold the global energy market hostage, and that we can't go on this way, that this regime is intolerably hostile to not just the United States, but to all of its neighbors in the region. And so if we can sort of turn this around on them and make this more painful for them than it is for our partners and allies, eventually we can break that. And the other thing I'd quickly point out is that we see a race toward alternative infrastructure in the region, not just the Saudi petrol line, the east-west line that's running now about 7 million barrels a day. UAE has a group of pipelines. They're looking at ports in Oman down below the strait that could be serviced by these pipelines. I think that Iran really has an asset of diminishing value here in the Strait of Hormuz.
I'm glad you brought up that pipeline, because the Wall Street Journal overnight was saying how Saudi Arabia is pressing the United States to drop the blockade because they're concerned that Iran will go after their ports elsewhere, maybe get the Houthis involved when it comes to Bab el-Mandeb, and then hurt all those exports that are moving through the east-west pipeline. Do you potentially think that the Iranians are willing to go there?
Well, this has always been a concern, but I found it very interesting. I mean, we're now in, I guess, close to week 6 of this conflict, and the Houthi have literally done nothing. They could have started taking pot shots at shipping through the Red Sea at any point. I think they launched one missile at Israel, and it was intercepted. So you've really had an extremely muted response from the Houthi, who may be rethinking their life choices as partners of the Iranians, given what's happened to Iran over this period. So they remain a concern. You've got to keep an eye on them, but they really haven't done very much as of now. I find that very interesting.
There also is a question of what China is doing through all of this. There were reports about Xi Jinping talking about how the international order is crumbling into disarray. There has been reporting that China is providing certain weaponry to Iran. How difficult does it make the meeting between Xi Jinping and Donald Trump in the middle of May?
Well, it certainly ups the ante, as it were, on that summit coming up in May. And I found the timing of that quite interesting as well. China was asked very early in this conflict if they were going to cancel that meeting, given that they're supposed to be such good friends with the Iranians. And they said, no, we would like to see Mr. Trump. Maybe that is not entirely surprising. The president postponed it a month, but he's going to go. And I thought Chairman Xi's remarks at the visit of the Emirati Crown Prince itself also a telling development, that he wanted to host that high-level Emirati delegation at a moment when the Emirates are engaged against the Iranians. He said, the rule of law is so very important. You can't descend to the law of the jungle. Well, that's fine and well, and maybe he should respect that himself as he's starting to take looks at things like Taiwan. So I think, China has been really muted. They really don't have the capability to project power the way the United States has, both in the Caribbean and in the Gulf. And so I think that we will have high stakes for the meeting next month. But I think President Trump does hold a lot of cards.
Victoria, it's good to see you, to get your thoughts and an update. No doubt we'll catch up with you again soon. Victoria Coates there, the former Deputy National Security Advisor, on the situation between the US and the rest of the world right now. In just a moment, we'll catch up with the French government. We need to talk about the relationship between the US and the Europeans, the transatlantic divide that's opened up over the last 6 weeks.
Yeah, Xi Jinping was speaking in a meeting with the Spanish Prime Minister. So one of the European contingencies that has made themselves even closer to China, arguably, than the U.S. With respect to France, how willing are they going to be to join the effort? How many contingency plans do they have to really support their economy as oil prices take a huge hit out of GDP?
And this comes at a time when Emmanuel Macron is saying he's going to have this conference about reopening the Strait of Hormuz, but we haven't yet seen material impact of the Europeans in the region.
We'll talk about objectives for that conference in just a moment. Coming up, we'll catch up with the French Finance Minister, Roth, Lescure, with Europe under pressure from the war. Plus, Yahara has your morning movers. Check it out. United CEO pitching a massive airline merger. The latest report on that in just a moment. Live from New York City, you're watching Bloomberg TV. Stocks advancing in yesterday's session, wiping out the losses since this war started on the S&P 500. On the Nasdaq, 9 consecutive days of gains. On the Nasdaq 100 this morning, positive once again, up by 0.4%. We've got a morning full of bank earnings for you. JPMorgan about 15 minutes away. Moments ago, numbers from Wells Fargo with the latest. Danny Berger has more. Hey, Danny.
Hey, John. It looks like a miss across the board. Let's start with the big number of net interest income. That comes in at $12.1 billion. That is a slight miss. The expectation was for just under $12.3 billion. The hope was it would be a Wells Fargo, at least with their outlook, aided by a lack of Fed rate cuts. But again, net interest income coming in with a miss. The other thing we were looking from this bank was following U.S. regulators' asset cap removal last year. Can they sustain momentum and add to some of their business? It seems that instead, we have a miss on both investment banking and total average loans. First quarter investment banking fees come in at $796 million. The estimate was for far greater than that, $835 million. Total average loans, that comes in, again, that's slightly higher, 996. So that is the bright spot for total average loans. Another sore spot for them is expenses. This is something Wells Fargo had missed big on last quarter and said our expenses are coming down. We're having fewer severance costs. Instead, a slight higher amount for expenses coming in at $14.3 billion. The estimate was for $14.23 billion. The other thing we're looking out for is any drop in credit quality. Their provisions for credit losses, that is also slightly higher than expected, coming in at $1.14 billion. Again, that is only slightly higher. $1.13 billion is what we are expecting. The CEO, though, putting in the statement that credit performance remains strong despite those higher than expected numbers when it comes to credit provisions. Their headcount is down, but John, expenses are higher and a miss on net interest income and a miss on some of the growth engines that should have been there for Wells Fargo, like investment banking.
Driving the stock lower in the pre-market. Danny, thank you. Stay close. We'll get to JPMorgan later on this hour with Danny Berger. That stock is down in the pre-market by 2.6%. The way things are stacking up this morning, Wells Fargo first, JPMorgan at about 15 minutes time, and then we'll hear from Citigroup, Bramo, somewhere around the 8 o'clock hour.
Yeah, and a lot of what will determine the reaction in markets is how high the expectation is. Just to sort of give a frame of reference, Wells Fargo shares were lower by more than 6% heading into this so far this year. So already taking some of the heat out of that, JPMorgan's going to really be the biggie to understand whether they can capitalize on the capital markets boom that we've seen so far this year.
A slight miss on Wells Fargo. Some major news coming out of the airline sector we need to stay on top of as well. Let's get to your morning movers. Yahara has more. Hey, Yahara.
Hi, John. Exactly. One of the biggest ever airline deals could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a merger with American Airlines to senior government officials. So you are seeing shares of American up 5.25%. United also up on that news. We're also seeing shares of the satellite firm Global Star soaring in the pre-market, up 13.7%. Also on some potential M&A news on our reporting that Amazon is close to buying the company as it tries to compete with SpaceX and its massive Starlink network. We are also seeing shares of Bloom Energy soaring up 13.5% after expanding its partnership with Oracle in a deal that could deliver 2.8 gigawatts of power to Oracle's massive AI data center network. John?
Yahara, thank you. Thanks for the update. Still thinking about that American United tie-up. What's Kirby up to here? Is he anchoring us to the extreme so we can go after something else a little smaller? Where's this going?
Well, he wants to get assets. He actually was speaking to us earlier this year, and he was talking about how any kind of downturn, he is ready to pick stuff up. And does that mean entire airlines? Well, we shall see. I'm not going to talk about it. But this really is a question of what can get done given all the attempts in the recent past.
The latest on United Airlines and American. JPMorgan numbers, I believe, just crossing as well, Bramo. They're coming a little bit earlier than expected. Let's get into some of that. We just heard from Wells Fargo. Slight miss there on Wells. Heard from Goldman, driven lower yesterday, driven by a miss on FIC. The numbers elsewhere pretty decent. What are you seeing on JPMorgan?
Right now, a beat pretty much across the board. FIC sales and trading, let's start with that, given the fact that Goldman Sachs missed. It came in at $7.1 billion. The estimate was for $6.65 billion. Equity sales and trading revenue came in at $4.48 billion versus the estimate of $4.3 billion. You could see pretty much across the board talking about how performance was strong, talking about beating estimates on earnings per share as well as revenue. So a real question here about what what they could accomplish that Wells Fargo couldn't when we just saw those results.
Equity sales and trading, to Bramo's point, upside surprise. Decent upside surprise from Goldman. The miss was on FICC. There is no miss on FICC when it comes to JPMorgan. Some commentary from the JPMorgan CEO, Jamie Dimon, as well. We'll get to those comments in just a moment. Danny Berger has some details for you right now. Hey, Danny.
Hey, John, I'm looking at record quarters for equity trading. And again, this is important considering Goldman had a huge quarter too. Can JPMorgan beat it? They did not beat Goldman, but again, at $4.5 billion, just there under, it is a record. And again, that FICC number, even more important, considering that Goldman Sachs lost. That also looks to be something of a record for them. The last record was $5.8 billion. And this exceeds their estimates at $7 billion. The other really important thing for JPMorgan was the fact that they missed on their investment banking in the last quarter's results. They said it's because the pipeline has been delayed. So you should see that show up. And it has indeed showed up. Investment banking revenue, $3.1 billion. The estimate was for $2.7 billion. It's a standout for them. We'll see how the advisory numbers come in, but we're also getting some commentary from Jamie Dimon as well, saying that he hopes regulators prioritized well-designed regulation. Keep in mind, that's part of the reason why we're seeing their investment banking outperform, saying that the U.S. economy remained resilient in the quarter and several tailwinds are supporting this resiliency. Contrast that with what we heard from David Solomon, warning about concerns of economic and wider stress coming from geopolitics. Instead, we have a CEO of JPMorgan saying that there are tailwinds supporting this economy. And we're also looking to see any commentary on credit. Jamie Dimon saying that they have ample amounts of capital and liquidity and that consumers are still earning and still spending. So again, a beat across the board for JPMorgan, a record for their equity trading, a record for their FICC trading, and you have an investment bank after a blockbuster quarter from M&A that also beats something we wanted to see from JPMorgan considering they missed last quarter.
Danny, thank you. Finding ourselves saying beat quite a few times whilst looking at JPMorgan, FICC, equities, investment banking. The commentary is important from the JPMorgan boss, the CEO and chair, Jamie Dimon, at a time when we've just seen a massive energy shock. The economy is still resilient. There's tailwind supporting this economy. Consumers still earning, still spending.
And right now, they have ample liquidity and they see credit quality as hanging in there. All of this with the beats in the capital markets. Key question has been, and it will be on the call, how much is the backlog potentially going to get shrunk as ongoing uncertainty continues in the Middle East? The markets may be moving on, but regulators and policymakers certainly can't do that.
This is an important headline from JPMorgan, just to wrap things up here. They see full year net interest income of about $103 billion. They had seen about 104.5. That number just crossed in seconds ago.
Yeah, so a little bit lower than what they had previously been seeing. Still, nonetheless, $103 billion is nothing to sneeze at and still would be, I believe, a new record. So it's not as if people are going to be crying about that. Nonetheless, how much are banks going to try to guide conservatively, given the fact, and I guess that's conservative, more conservatively based on some of the uncertainties?
There are many tailwinds here for this economy. The JPMorgan boss cites a few of them: fiscal stimulus, AI-driven capital investment. There is a key headwind we need to talk about as well, which is why we're even having this conversation, which is the shock in the Middle East and what can be done about it. We understand this morning, according to headlines, that France and the UK is co-hosting a summit this weekend to discuss safeguarding international shipping. I'm very pleased to say we can have that conversation right now around this table, because joining us is Lescure, the French Minister for the Economy and Finance. Minister, good morning. It's good to see you.
Good morning.
Thank you for being here and welcome to New York City. Let's talk about the objectives for this meeting. What can we hope for over the next week?
Well, we can hope for de-escalation. I mean, you know that France wasn't part of the conflict, as we're not a belligerent, we're not even warned that it was going to happen. But now we are where we are. And we feel, with others, the UK and others, we can be part of the solution. We need de-escalation first. We need those talks that are happening, and which hopefully will keep on happening between Iran and the US to, move towards some kind of solution. But if we do have de-escalation, we feel that a coalition of the willing, countries from all over the place that have a part in the problem, because as you know, this Strait of Hormuz story is affecting us all economically in Asia, dramatically, and in Europe as well, that we can help pacify the strait. That strait is the knot of the economic impact of that conflict. If we can undo that knot, we know that we'll all be in a better place. So whatever we can do, once there's de-escalation, that's important, to help make the Strait of Hormuz more free, we will do. And that's what's happening on Friday.
What does that actually mean in reality, whatever we can do? does that mean you'd have a military presence in the Strait of Hormuz? What does that actually mean?
Well,
in
look
practice?
at what's happening in the Red Sea, and it has happened for a while. You know, there was Houthis there. They were making passage dangerous for ships. And we had, and we still have, coalition of partners that are just making it safe, just deterring attacks from the Houthis. And, you know, we are in there, the Spanish are in there, there's a few countries in there. Obviously, the Strait of Hormuz would be probably a bigger deal to do, but we can do it, provided, again, that we have the escalation, we have some path to a lasting ceasefire. That will require major headway on, you know, on nuclear, on ballistic capabilities of Iran that have to be gone. But once we have that, there's a case for non-belligerent country to be part of the solution to pacify the Strait, which again is the knot of the economic impact.
We have to talk about consequences as well. I'm not sure how well understood the energy mix story is in France. At the European level, it's been a bit of a mess in places like Germany, particularly the UK. That's been highlighted so many times. Can you briefly describe the energy mix in France, how different it is and how insulated you might be?
You know, I remember Rahm Emanuel, when Barack Obama came into office, that said you should never let a good economic crisis go to waste. Well, this is what France did in the 70s, when we had an oil shock then. France decided to embark on a major nuclear program that allowed us to go down from 90% hydrocarbon in our energy mix to 60. So 40% of our energy now is coming from nuclear. It's carbon-free, it's cheap, and it's completely sovereign. It doesn't depend on anyone else. And because we don't want this economic crisis to go to waste, we've just announced that we're doubling down. So we're going to bring that energy mix from 90 to 60 to 35 by investing again in nuclear, as well as hydro, as well as renewables. At the end of the day, we have a convergence now of three major driving forces that we have an interest in investing. Geopolitical issues. We have to be sovereign. We have to be more independent of what's happening elsewhere. The environment. You know, I think climate is coming back because it's been on a bit of a back burner for a while, but because we see we're depending way too much of one region of the Gulf and of hydrocarbon, it's coming back. But also jobs. By doing this, we're going to create hundreds of thousands of jobs because building a nuclear power station, you know, building wind farms and solar farms are helpful for the jobs on the ground.
This is all expensive, and it takes money at a time where the amount of debt globally has reached record highs, has surged dramatically since the pandemic. How much fiscal headroom do you have?
Well, it's all going to be about priorities. You know, we can't have it all. And today we have one priority, which is sovereignty, which has two pillars. Defense sovereignty. We will have doubled defense spending in France between 2017 and 2027 by the time we get there next year. And energy sovereignty. So that means we have to save elsewhere. You know, we have to save on our health spending, we have to save on our retirement spending, and you know it's a big debate in France. We've done so. We've managed to get a budget through, and I can tell you it wasn't easy with a Congress that looks, you know, as I said to my Italian colleague, a bit like an Italian Congress, you know, lots of different groups having to discuss and muddle through, but we did. And we're going to have to do it again. But most importantly, I think there's a presidential election taking place next year. And the candidates are going to have to make their choice. Do they want priority on sovereignty, defense and electricity and energy to make France, and at the end of the day, Europe, a stronger place? Or do we still want to be kind of stuck in the past of things we have to change and reform?
Do you expect growth to have to go down because you're saving in these other areas to preserve the sovereignty with respect to energy, with respect to defense?
Well, we entered that crisis on quite a strong footing. I heard Jamie Dimon saying that the US economy is resilient. So is the French economy. It was pretty strong getting into that crisis. So we will have a slowdown in the short run. But again, what we're doing is investment. At the moment, when someone wants to put a data center somewhere, not in the US, they look at France. Because we have carbon-free, ample and cheap electricity, and they need that. So at the end of the day, this is investment in the French economy, in the European economy, but it is attracting investments, including from the part of US investors who want to diversify. We're having, you know, the Magnificent Seven looking at France to invest. We're having US banks looking to invest, and we have French and European companies also looking to invest. So again, short-term resilience, but a bit of a risk. Long term, we need to invest in the future. That's the only way out. Growth is the way out.
When you look at the long term, when will France finally stop buying Russian fossil fuels?
Well, you know, we're committed to that. We're already committed to stopping gas import. There's no new contracts. This has been decided at European level this year. And any gas import is going to be stopped by January. So we are on the path. The only thing we wanted to do is to make sure that this was done respecting international laws. We are a law-binding country, and the EU is a law-binding country, so we did it respecting some contracts that were still in the go, respecting European decisions, the sanctions decision as well. And this is all taking place the way it should be, respecting international law, which Russia doesn't.
A final question, an important one. You've used the word belligerence to describe others. The US might be in that group in your mind. You can confirm that if you want to. The other question and the other answer you've offered is the word sovereign. This is important with regards to the future of a relationship with the US. Just what is the transatlantic relationship, given the way the discourse has evolved over the last month?
We've been friends for 250 years. You know, and this is going to go beyond the ups and downs, and there are some of the somewhat interpersonal relationship or somewhat disagreement on the short-term way of dealing with such and such problem. What gets us together is much stronger than what divides us. And I can see it every day when I talk to US and French and European companies. We need those companies to keep on working together to give us the right example of what we need to do. When we disagree, I'm going to chair a G7 meeting this week. Sometimes we don't agree on everything with our finance colleagues. We address it in closed rooms. We are allies and friends, and this needs to go beyond what's going on in the ground. We have the solutions to the problem together, and we need to make sure that everyone understands this. We're stronger together than divided. Despite sometimes the somewhat short-term disagreement, we need to look beyond that and make sure we do.
Minister, it's good to see you. Thanks for your time.
Thank you.
Enjoy New York.
Thanks to the three
I know
of
you're
you.
heading back to DC as well, so enjoy America. Equity futures right now in the S&P 500 positive by 0.1%. Lots of bank earnings out there and stories elsewhere. With your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. A U.S. sanctioned tanker linked to China made its way through the Strait of Hormuz despite President Donald Trump's naval blockade. Rich Starry, a medium-range tanker earlier known as Full Star, was blacklisted by Washington back in 2023 for helping Tehran evade energy sanctions. And on those bank earnings, we are seeing JPMorgan shares falling 2.6%. The bank cutting its net interest income forecast for the full year. Still, JPMorgan reporting a strong first quarter, fixed sales and trading revenue rising 21% compared to a year ago. Wells Fargo shares also lower about 0.8%. The company reporting net interest income for the first quarter that missed estimates. Wells Fargo still seeing its full year net interest income at about $50 billion. That's your Bloomberg brief. John.
Yahira, thank you. Thank you very much. Up next, bank earnings in focus.
Most of the volatility, I think, is positive. I think the companies understand how to make a dollar when you have these topsy-turvy markets. This uncertainty can pass just like it did last year. So I still think there's a very good road ahead.
The numbers from JPMorgan were good. The guide was a little softer than expected. Gerard Cassidy of RBC joins us next. The quarterly numbers were good. The guide was soft. JPMorgan down in the pre-market by 2.6%. With the details, Danny has more. Hey, Danny.
Hey, John. It is that net interest income guide. The confusing thing and the details that we will want is the fact that JPMorgan is actually reverting to an old guidance. In the quarter prior, it had told us that for 2026, net interest income would be $104.5 billion for the year. In January, it had said it would be $103 billion. It's gone back to that forecast. So there's going to be some question marks about what's changed in the outlook for JPMorgan to cause them to do that. Now, otherwise, it was a really bright earnings, and that's why you saw originally shares surge higher before you had this new forecast, because everything beat. It was a record quarter for equities. FIT came in for a second best quarter, the best one being during COVID trading times, and that was a number that Goldman Sachs had missed on. Its investment bank also really strong. Its advisory fees surging 82% year over year. Again, this is a bright spot for JPMorgan after seeing some of its deals pipeline pushed into the first quarter. So it is that one sour spot. Now, keep in mind that it's not exactly trading at high valuations coming into this. JPMorgan and the rest of the big banks are down on the year, but still there's some disappointment. It's about that guidance. And again, to Jamie Dimon's point, he's pointing out resiliency in the economy. He does talk about risks and uncertainties and around geopolitical stress, but saying that there are many pillars supporting them, including AI-driven capital investment.
Danny Berger with the latest. Danny's with us all morning breaking down these results. Citi is up next. Jared Cassidy of RBC spent the morning with us as well. Jared, welcome into the programme. We used to beat and raise from JPMorgan, not beat and cut. What's behind the cut?
I think, John, what we're seeing is that there was very strong loan growth, both by JPMorgan and Wells Fargo, but both of them experienced a slight decline in the net interest margin. So there was a compression in the spreads, and I think that's probably attributing to the lower guidance on the NII for JPMorgan for the full calendar year 2026. But as you pointed out earlier, John, Wells Fargo held their guide for net interest income. So it's a question of volume versus spread, and the spread came in a little tighter for both those banks.
Gerard, I'm struck by the fact that even though it's beat pretty much across the board, the shares are lower. Do you think that this truly is net income interest, or just simply buy the rumor, sell the news?
I think it's the latter, and I think you bring a good point. It's a little surprising that the stock is down that much on these results, and even the outlook. The outlook, though, the net interest income, as you guys just pointed out, has been moving around between the 103 to 105 billion. It's not a significant lowering to suggest why the stock is down. And also, as you guys pointed out, the capital markets numbers for JPMorgan were very robust this quarter as well.
We heard Goldman Sachs' CEO yesterday blame the analyst essentially for their miss in FICC, saying that they just simply had expectations that were way too high. It's their fault. Do you expect similar commentary from JPMorgan this morning?
I'd be surprised, because I was looking at our numbers and consensus compared to JPMorgan's numbers, and generally they came in better than expected, including FICC. So it's going to be interesting to see what others report. Citi, as you know, reports later this morning. Then we'll, of course, receive Bank of America and Morgan Stanley later in the week. And if everybody beats expectations on FICC, then Goldman had a tougher quarter. They didn't indicate yesterday that there was any trading losses or anything, which is what we suspected. But when questioned on the call about the softness there, that once again, it was more due to the rates business and mortgages being partially offset by better commodities trading and currency trading for Goldman yesterday.
Jared, it's good to see you. You're going to be sticking with us through this morning. Looking forward to catching up some more. Jared Cassidy there of RBC. I've never enjoyed that. Blaming the analysts, blaming the media. Just own the results.
Well, it didn't seem to work.
And own the outcome.
Well, it didn't seem to work, because ultimately you saw the shares respond heading lower. A question, though, here of how much the optimism has been overbaked in some of these book-to-loan values in some of the banks. And that, I think, is maybe what we might see in some of the post-results trading. JPMorgan down by close to 2% in the pre-market. Just not what we're used to, Bramo. Usually when you see beats like that on a quarter from JPMorgan, the headline that leaks a couple of minutes later across the Bloomberg terminal, and you see it cross, it's the guidance for net interest income, and usually it's higher than it was before. And $103 billion isn't nothing. But yes, the idea of guiding lower is something unusual. Stock is down by close to 2% in early trading. The conversation continues. In the next hour, we'll catch up with Eric Johnston of Cantor, Rachel Ziemba of CNAS, Amy Gower of Morgan Stanley, Desai of Franklin Templeton. The second hour of Bloomberg Surveillance is just around the corner.
Inflation is now too high.
We live in a world of higher, more volatile inflation.
There's still a number of unknowns.
Uncertainty breeds conservatism in terms of spending and hiring.
There's damage that's going to persist.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price section of scores look like this. Equity futures firmer by about 0.1% on the S&P. On the NASDAQ, up by a third. The NASDAQ, 9-day winning streak. The S&P within 2% of all-time highs. In the commodity market, first thing you look at still, Most mornings, crude, Brent, WTI below triple digits. 99 on Brent, WTI at 97. Holding us back just a touch today, these numbers from JPMorgan. Quarterly results were good. The guide was a little soft. The stock is down by more than 1%.
Yeah, the guide a little soft, bringing us back to where we were in terms of the guide from January. $103 billion versus $104.5 billion. Still massive numbers and beats pretty much across the board. You got FIC outperforming. You had equities trading and sales outperforming. You had net interest income for the quarter outperforming. The commentary from Jamie Dimon of JPMorgan, interesting, saying that ultimately this is a difficult moment. There are fiscal stimulus and AI-driven capital investments that act as tailwinds. At the same time, the headwinds of energy costs and geopolitical conflicts still loom large.
The economy is resilient. We've heard that from Jamie Dimon and JPMorgan a few times. Consumers are still earning. They're still spending. The risks, they're complex. They include wars and energy prices.
And what we see, depending on these results and what the CEOs are saying in the C-suite, is very different than what you see in the polls. In the polls, you see everyday consumers are concerned about where gas prices are, north of $4 a gallon when it comes across the average for the United States. At the same time, they are still going out and spending, which is why you have executives saying we do see this consumer to be resilient. They might not be happy about it, but they're still spending.
Things have been pretty mixed so far. JPMorgan, Goldman Sachs, we've heard from Wells, Citi, the next to go. Then we'll hear from Bank of America and Morgan Stanley in the next 24 hours.
One of the difficult aspects of this is they are potentially preparing for difficulties down the line, not seeing it yet. You're also not hearing concerns about private credit or any kind of serious credit deterioration that is at least making itself manifest on the balance sheet. So how does an investor deal with this when the unknowns are still a complete black box? The crystal ball that people look at is completely cloudy. So how, as an investor, do you game this out? I would say look past it. It's a FOMO market.
And it's very difficult when you really don't understand what is going to happen in the Middle East. We're supposed to have the end of this ceasefire, potentially talks just before them. But what's on the table right now is what's been on the table. It was on the table in February before Trump decided to escalate and start striking Iran. So this could, as Victoria Coates said, this could drag on for months, especially given the Iranians are very aware that there's a midterm election in this country. Then the president after that only has 2 more years.
We have thrown so much of this equity market. Private market jitters, AI disruption, a major, and I mean major energy shock, and we are within 1.5% of all-time highs on the S&P 500. Futures this morning positive by a tenth of 1%. Coming up this hour, we'll catch up with Eric Johnston of Cantor as big bank earnings roll in. Rachel Ziemba of the Center for a New American Security on hopes for a U.S.-Iran deal. And Desai of Franklin Templeton as the Fed weighs its next move. We begin this hour with stocks looking for direction following JPMorgan's first quarter earnings. Eric Johnston of Cantor Fitzgerald writing the U.S. economy and corporate earnings are quite strong and can handle a short-term spike in oil and short-term supply shocks across different inputs. Eric joins us now for more. Eric, good morning. Good to see you.
Good morning.
Just to add to that, I've talked about what we've thrown at this equity market, private market jitters, AI disruption, an energy shock. And to your point, the negative supply shocks elsewhere as well, across labor and goods. And here we are, very close to all-time highs. What's anchoring that for you?
So I would say a couple of things. Even though price is only down, call it 1.5% from the all-time high, as you said, if you look at the multiple, that's down very significantly. So the peak was about 22.8 times forward earnings. We entered this year at a little over 22 times forward earnings, and now we're just above 20. And that's because earnings estimates have, over the last 6 months and over the last, 2 to 3 months have surged. So by going sideways, the market has actually been correcting the multiple. So if you look at a multiple chart and you said that was a stock price chart, you would say, wow, we're still very oversold. So I think that has created that sort of, entry point, making it look attractive, even being 1.5%, from the highs.
How sticky do you think that multiple compression is?
So I think that 22.8 probably was not correct and was too high. But the earnings growth rate right now, and most of it is really, it's due to AI, right? It's due to the build out. But you're seeing a growth rate that's likely going to persist in this mid-teens range. And if you look at it versus history, you've got mid-teens growth. You've had debt levels that, looking back over the last 50 to 75 years, corporate debt is very low. CapEx, of course, has gone up of late, but also relative to history is also on the lower end. So a 20 multiple, while I still think is on the higher end, I think is something that could be sustained and potentially move a little bit higher from here as the year goes on.
Does that mean that you think that big tech has to lead on any kind of rally, any kind of upside, given the diminished expectations for growth due to the conflict in the Middle East?
Absolutely. I think this earnings season is going to be a very positive earnings season for mega cap tech relative to their stock prices. And so, mega cap tech has gotten hit hard. The multiples have gotten hit hard. And a lot of this earnings estimate revision higher has actually been from tech while the stocks have been getting hit. So I think as you look to this earnings season, I think you're going to see, growth rates in cloud that are going to be very attractive. I think the commentary about the outlook for that growth rate over the coming years is also going to be quite favorable. So yes, I think you need mega cap tech, and I think you'll get it.
John's been talking about this for quite a while. How much room do they have to keep increasing their CapEx spending, given the fact that there are some concerns by investors of exactly what kind of return they're getting, and frankly, the fact that they're becoming more asset heavy in terms of their overall model?
I mean, there's still a very large mismatch between the demand for compute and the supply, and there's likely going to be continued issues in terms of just building it, like actually just being able to physically get all the pieces to build the data centers to meet the demand. And so that's probably going to elongate the cycle. And so I think that in the near term, I don't really see any change to that CapEx outlook.
There's also been concern from some individuals, especially on the Federal Reserve, that maybe they can't do anything. They have to sit on their hands because of what is going on, given the inflationary shock of the energy story. But you actually think the Fed is going to cut this year. You still think that?
I do. So the market's only pricing in a 40% chance of one cut. I think we're going to see multiple cuts. And I think it's really with, I think core inflation. So presumably the end of the war will be there sometime in the next, coming weeks and months. And so as we get to the back half of the year, I think that the headline inflation numbers are going to be looked at by the Fed as old news. And they will have already seen the starting of the move lower in oil, and I think it's going to go a lot slower than people, hope for, but is on the move down. And that core inflation is going to really be what is going to be moving lower, and will be the rationale for the Fed to cut. And I think that this AI, surge in, you look at Anthropic's revenues, right? There's likely going to start to be headwinds, or continue to be headwinds, for the labor market. And I think that's going to be for years to come.
And you think we'll see that this year, AI impact basically layoffs?
I think some of that impact in the back half of the year, but we're also going to be lapping tariffs, which I think is going to be very important for goods prices. I think the owner's equivalent rent is just on a downtrend, and based on the current data, should be on a downtrend for the next year plus. And then I think wage growth is certainly going to be under pressure due to that AI dynamic. So I think if you put that all together, we'll be looking at core inflation rates in the back half of the year that are going to be enough for the Fed to cut. And of course, you're going to have a head of the of the committee that is going to be quite incentivized to cut. He's only one vote, but is going to be quite incentivized to cut. And I think that could have significant influence on the committee.
Just extend that a few steps further. You've got AI disruption leading to layoffs in the labour market, and the Fed chasing something they can't affect. Cutting interest rates. For a jobs market they can't change, right? How far are they going to chase that? Because arguably them cutting interest rates will just accelerate further AI investment, no?
So historically, the Fed has been much more sort of backward looking, and I think one of the changes that they want to make is becoming much more forward looking. And I think with Warsh in there leading, I think he's going to be much more forward looking. Now, what is the impact going to be? That's where it gets very murky, and likely the impact is not necessarily going to be there, but ultimately the goal is going to be to spur demand beyond what it would be otherwise. That's going to be a tricky.
I'm struck by the fact that it feels like this market's saying mission accomplished. I feel like this market is collectively on some sort of aircraft carrier with a huge banner saying mission accomplished, we're moving on. And at the same time, oil prices are going to be materially higher. I just wonder at what point higher inflation starts to really bleed into the calculus in a more sustained way.
So one of the interesting things, if you look at a chart of oil prices over the last 15, 20 years, oil prices today are the same as they were in 2008. Okay, that was during the spike in 08, to be fair, but the same as 2008. Wealth since 2008 has gone up by about sixfold, like 600%. And so the impact, while oil clearly has an impact on a certain segment of the consumer and a painful impact on that segment of the consumer, if you look at the consumer broadly, consumer spending is not really being impacted because of this wealth creation that makes oil prices on a relative basis such a small part of the consumer's spending. And even though we've seen a surge in oil prices, and of course, rate of change is super important. But we're also the same price. If you look at 6-month oil, it's the same as it was in 2024, same as it was in 2023, below where it was in 2022. So I think as long as we are here around oil prices, the economy and earnings can definitely handle it. Now, to your point, the market, I think, is saying that we are pricing in a very high probability that it is mission accomplished and that we're not going to see a further move higher in oil. And I think in war, you can assume nothing. And so that is something, until we have a deal, it still remains a risk, even though, I think the odds have certainly gone down that this is going to be extended and that the ceasefire will be broken. I think that those odds are definitely moving lower. But they still exist, and you can assume nothing.
This stock market has taken a lot of comfort from the futures curve in the oil market. Eric, it's good to see you.
Yes, great to see you.
Thanks for breaking it down. Thank you. Eric Johnston there of Cantor Fitzgerald. Within 1.5% of all-time highs on the S&P 500. Equity futures this morning positive again by about 0.1%. With an update on stories worldwide, with your Bloomberg brief, Yahira has more. Hey, Yahira.
Hi, John. Starting with bank earnings, shares of JPMorgan and Wells Fargo both lower in the pre-market. JPMorgan cutting its net interest income forecast for the full year, with CEO Jamie Dimon seeing, quote, an increasingly complex set of risks ahead. Wells Fargo posting net interest income that missed estimates. Meanwhile, we are seeing shares of CarMax plunging 6.7% in the pre-market. The used car retailer reporting fourth quarter results that beat Wall Street estimates, but said it will spend $500 million in fiscal 2027 to support longer-term growth. And California Congressman Eric Swalwell is resigning from his seat after suspending his campaign for governor. Swalwell is facing allegations of sexual assault by a former staffer, with the House Ethics Committee set to launch an investigation. Texas Congressman Tony Gonzalez is also resigning after admitting to an affair with a former staffer. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for the update. More from Yahira in about 15 minutes' time. Up next on the program, putting the ball back in Iran's court.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court.
Up next, we'll catch up with Rachel Ziemba of the Center for a New American Security. Live from New York City this morning. Good morning. Stocks higher for 8 days out of the last 9. Up again this morning. Futures positive by 0.2% on the S&P. On the Nasdaq up by 0.4. The enthusiasm continues on the prospect of further talks in the Middle East. And the earnings keep rolling in as well. This from JPMorgan. Trading revenue up 20% from a year earlier. This stat from Hannah Levitt here at Bloomberg. Traders at JPMorgan posting their highest ever quarterly revenue in the first 3 months of the year. The stock is slightly lower. We're down by close to 0.9%. The guide, net interest income for the year ahead, just slightly softer than what they were guiding towards just before.
Yeah, there was this feeling back in February, a long time ago, when everyone expected the expansion to surprise to the upside in the United States. And so any enthusiasm that was baked in during that period had to be retrenched a bit back to where it was earlier this year. Still $103 billion of net interest and income. Not a terrible haul.
The JPMorgan down by 0.9% in the pre-market. Up next is Citi at some point in the next hour. Under surveillance this morning, putting the ball back in Iran's court.
The Iranians, I think, did make some progress. They moved in our direction, which is why I think we would say that we had some good signs, but they didn't move far enough. The ball really is in their court. We've made clear where we're willing, again, to be accommodating, and we've made clear where we absolutely need to see the nuclear material come out of the country of Iran. We can start to wind this thing down. I'd much rather wind this thing down with a big, successful negotiation.
So here's the latest this morning. The US and Iran waiting a fresh round of talks before the ceasefire ends next week. Bloomberg's Tyler Kendall joins us now for more. Tyler, what is the potential for a much bigger, successful negotiation?
Hey, John. Good morning. Well, at this point, it seems that potential is ramping up as we get indications that diplomacy is still a viable option on the table. People familiar with the matter telling us here at Bloomberg News that the goal is that there could be a face-to-face negotiation ahead of next Tuesday's ceasefire deadline. President Trump indicated as much yesterday, too, telling reporters that Iran had reached out to the U.S. for talks, but also maintained that the timetable for a deal with Iran has not changed. Now, this White House has repeatedly maintained that the reason why we didn't see a resolution to the last round of talks has to do with Iran's nuclear ambitions. However, we're getting multiple reports from different outlets that the U.S. has actually shifted its asks when it comes to Iran's program. Outlets including Axios, The Wall Street Journal, and The New York Times now reporting that the U.S. had asked Iran to agree to a 20-year moratorium on uranium enrichment, different, of course, from a previous demand of a permanent ban, though, of course, we still need to get additional details on what else was in this ask, including further restrictions. Now, John, at this point, even as we have the potential for more dialogue, there is, of course, the potential for more escalation. New overnight, Saudi Arabia asked the U.S. outright to end its blockade amid concerns that there could be real retaliation in ports in the region. President Trump indicated yesterday we could get some more details today on which countries may be willing to help when it comes to securing the Strait of Hormuz. But as the French economy and finance minister told you all earlier on the program, it appears clear that our allies need to get more signs of de-escalation before they commit any other assets to the region.
Tyler, good to see you as always. Tyler Kendall there down in Washington, D.C. in the nation's capital. Joining us now is Rachel Ziemba of the Center for a New American Security. Rachel, welcome to the program. Annmarie and Victoria Coates were talking about this in the previous hour. The American strategy has changed. They've gone from lifting some sanctions on some Iranian crude to ultimately blockading all Iranian crude. Rachel, what do you expect to be the outcome of this shift in strategy?
Yeah, well, the U.S. government, thanks for having me, John. The U.S. government is really hoping that this blockade will bring Iran to not only back to the table, but make more concessions. I would note that the Iranian response to the U.S. 20-year moratorium has been to come back with another 5-year one, which I think is similar to what they were offering back in February before this war. So we'll see how much movement we've seen. But ultimately, what this means is that oil flows is that the oil flows from Iran, if this blockade is effective, could fall. That could be 2 million barrels a day further offline that was going to China. Taking outages from the Gulf from 10, 11 million barrels a day to maybe 13 or so. So it would just increase the outage that we're seeing here. But the U.S. government is hoping that we get to a resolution. But right now, we're seeing a few sanctioned vessels making their way through the strait. Will they be stopped by U.S. military when they get further out into the Gulf of Oman? We'll see. I think that will be one of the stories for today and the next few days.
Rachel, speaking of that blockade, if the United States does take over a tanker, is it clear to you where exactly they would bring it?
No, it's not. We are in uncharted territory. There was a point earlier this year before the war where the U.S. was, I called it at the time, they were using, kinetic force to implement financial sanctions. They did it with Venezuela, a little bit with tankers going to Cuba, a couple Iranian tankers, but a lot of them just sort of spent time out at sea. Some of the Venezuelan ones eventually came to the United States or went to Caribbean ports. It's possible some of these could go to Oman, could go somewhere else and get processed, could go to friendly countries in Asia. But it's not clear to me that CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China, right? China has been the buyer of first and last resort for Iran. It's also been the primary buyer of the Russia sanctions. And I'd note as well that the U.S. government I'm sure I've talked about this, but have let the Russia sanctions lapse within the last couple of days, largely because China was the one who was still buying most of that oil.
In order for the Iranians to maybe capitulate for the United States, does the blockade need to go on for longer? Because before the blockade, and we were just discussing the sanction lift on Iranian crude at sea, the regime brought in hundreds of millions of dollars because they were allowed to now export without the sanctions, so at a much higher premium.
You're spot on, Annmarie. Iran has been earning more in the last couple of months. They got more vessels out ahead of the war compared to what they were normally doing. It's pretty volatile oil flows out of Iran, I must admit. And they've been able to sell at much higher prices. Now, the sanctions relief that hasn't yet expired, but has been converted into this military blockade, did not lift any of the sanctions on what Iran could buy, how they could spend their resources. That's one of the reasons they want to be paid in crypto or renminbi or assets that don't touch the U.S. Treasury. But undeniably, Iran's military-led government has been able to support itself, and, it's sitting on more cash now, even as more cash is locked up. Now, that's not going to be enough for rebuilding Iran, but it could be enough for the regime to remain in place. And so I think that's where the U.S. government's view that this could be just a couple more weeks of pain, the timelines might not line up, in my view.
Rachel, good to catch up. Thanks for dropping by. Rachel Ziemba there of CNAS. To Bramo's point earlier on in the programme, it just feels like this market has just moved on completely from this story. We've got crude south of triple digits, the front month of the futures curve we're talking about here on both Brent and WTI. The physical market's still very disrupted, of course. The market's taking comfort from where the back end of the futures curve is trading, or at least further out on the futures curve, which implies crude's going to come back down, if you view the futures curve that way. And the equity market's looking elsewhere, looking hopefully to robust earnings for the year ahead.
The team over at Deutsche Bank just put out the chart of the day. The playbook pays off again. And it's the S&P 500 around geopolitical events since 1939, talking about how fade any kind of geopolitics since 1939. We're still in the geopolitical event. It's just that people are saying, in some ways, it's all clear. It's kind of mission accomplished. People see the off-ramp and they're going to buy on it.
It's not over yet. To your point, still in it.
We still haven't found out really a feasible resolution going forward.
Up next, we'll catch up with Amy Gower of Morgan Stanley with metals rising on renewed Iran optimism. Plus, your Hira's got your morning movers. The bank's in focus this morning from New York City. Good morning. The S&P 500, here's the reset. Wiping out the losses from the war, now positive on the year, an 8th day of gains out of 9 days of trading. The rally continues. Futures up this morning by 1/3%, call it 0.2% on the S&P 500, within, not 2%, but within 1.5% of all-time highs on the S&P, a 9-day winning streak on the Nasdaq 100, up again. Could be day 10, up again this morning by 0.4%. That's how the stage is set this morning. Let's get you some single names 2 hours away from the opening pound. Your morning movers with Yahira. Hey, Yahira.
Hi, John. Taking you through those bank earnings and how the stocks are reacting. We start with JPMorgan. Its traders blew past expectations with a record quarter, which is something we were watching after that massive Goldman miss yesterday on FIC trading, but it was the guidance that it disappointed investors. Shares are down 0.8%, but they have trimmed earlier losses. Meanwhile, we are also seeing Wells Fargo shares down 2.4% after the firm missed on net interest income and fees, key areas for that bank. Staying on Wall Street, we turn to BlackRock. Those shares up 2% in the pre-market after the company pulled in $130 billion in client inflows, with ETFs accounting for almost all of that. And we end on the airlines. One of the biggest airline deals ever could be on the table. We're reporting that United CEO's Scott Kirby has floated a potential merger with American Airlines, that he's talked to senior government officials about that. So now we are seeing American adding to its earlier gains, up 7.4%. John?
Yahira, thank you. I find this a major flex. It's just a flex. Got a really tough moment for the airlines, given the fuel cost situation, and you've got one name coming out and saying, yeah, we're ready to buy. We're ready to go.
It's a specific flex, too, because remember that the CEO of United used to work as the president of American Airlines. So it's a really interesting moment and an increasing rivalry between the big three.
More still to come on that story. On our radar this morning, the US and Iran weighing further negotiations as President Donald Trump presses ahead with a naval blockade in the Strait of Hormuz. The two countries aiming to extend the 2-week ceasefire before it expires on April 22. Elsewhere, that story. United, the CEO, Scott Kirby, floating a massive merger with rival Americans. Sources telling us here at Bloomberg, Kirby pitched the idea to senior government officials. A deal would require approval from both the DOT and the DOJ. And finally, let's finish on the bank. Shares of JPMorgan and Wells Fargo trading lower in the pre-market. JPMorgan Bank cutting its net interest income forecast for the full year. Wells Fargo posting net interest for the first quarter that missed analyst estimates.
Just to put it into perspective, I feel like a broken record, but $103 billion was the downgrade from 104.5. That was the upgrade from January to February, and then February back to where we are in April, and suddenly we're back to where we were when we began the year. These are wonderful earnings. The question is just how much expectations had gotten elevated heading into this. The fact that you're having a record investment banking, a record markets activity with respect to JPMorgan and Goldman Sachs highlights just how much energy there still is in the capital markets. And that, I think, is going to be the takeaway, even if there is a one-day snap in terms of the performance.
And it comes at a time when I know Jamie Dimon also likes to moonlight as a geopolitical risk analyst. He's talking about all of the risk. And at this moment, they feel like the wall of worry, those bricks continuously stack up. They are still doing so well.
Stock is down by just 0.8%. Let's talk about the shakeout in the commodity market, and not in crude. Gold snapping a 2-day losing streak with inflation concerns easing on renewed optimism for a peace deal with Iran. Amy Gower of Morgan Stanley writing the longer-term effects of current events in the Middle East are more bullish than bearish for metals if they bring more stockpiling. Amy joins us now for more. Amy, good morning.
Morning.
And welcome to New York as well. Let's talk about the degree of disruption you've seen in your space over the last 6 weeks. How have things changed?
Yeah, so look, the big change we've seen is really the aluminium market. This has been the most physically disrupted from the conflict so far. First of all, it was a question of we couldn't ship anything out. The region is about 9% of global aluminium production. Then we started worrying about getting those raw materials in, so the alumina and bauxite. And then we actually had some strikes on facilities and on energy infrastructure. And so we've lost about 4% of global aluminium production. And bear in mind, in commodities, we care about those very small imbalances. It's the price is set at the margin. So aluminium has been one of the standout performers so far. And what you typically see is when these disruptions happen, you're looking at 12 months to fix them. So that's been the big disrupted one. And then, of course, we've had some changes in these macro factors that have been a big driver for metals. So things like the dollar weakness had been a big tailwind. That reversed briefly, obviously coming back towards weakness again, changes in interest rate expectations. So that has taken a bit of the wind out of the sails for some of the others.
Let's just stick on that line, 12 months to fix. 12 months to fix the production, to get back to where we were pre-war. What does it mean for the demand story over the next year? How do you anticipate that's going to change?
Yeah, look, we anticipate there'll be about a 2 million tonne surplus in the aluminium market, which is a lot of demand to try and destroy. I think what we're seeing at the moment, similar to oil, we've got a very steep backwardation, so a downward slope in the aluminium curve. What that's trying to do is disincentivize holding excess inventory at end users at the moment. So we're sort of trying to incentivize everyone to hold as little as possible for now while we try and figure out where we can get a bit more supply. We might also start to see a bit of switching. So could you see perhaps some substitution towards things like steel in the auto sector? But I think it's going to stay a very, very tight market.
How much have you seen different regions pull up the slack, given the fact that in the Middle East there has been a destruction to facilities and a destruction to supplies? Are you seeing, for example, South America start to ramp up production? Australia, how much do you see sort of a shifting to different parts of the world?
Yeah, look, the challenge with aluminium is it's really all about electricity supply. And if we think about everything that's going on in the world with data centers and AI, the one thing that we're struggling with is electricity supply. The two regions where really you would think you could have a bit of response is China and Indonesia. Now, China is actually capped on its capacity. Potentially there's a room to increase slightly your amperage and get a little bit more out of it, but there's not that much that China can do. And then Indonesia has a good pipeline, but we kind of knew that that was coming already. They can't really do much quickly, and again, takes 12 months to fix a smelter, also takes time to ramp one up, and power costs are just becoming very, very difficult. I mean, even in the US, we've had smelters being sold to data centers, even where in the US you've not just got aluminium prices, but you've got this record Midwest premium. So the all-in price here is about $6,000, and that's still not been enough.
So this sounds really problematic. This sounds like it should be moving markets more. It seems like a shortage. It seems like something that's going to cause inflation. Are you as sanguine as the rest of markets that seem to be just sort of declaring the all clear, mission accomplished?
I think, look, there's clearly an element of positioning and flows here. Aluminium was already a very, very long market coming into this. So I would say it's not like the market was caught short and had to suddenly cover. And I think that explains partly it. Some of this is playing out also in the physical premiums in different regions. So, for example, in Europe, you used to pay about $300 on top of the aluminium price to get metal. You're now paying $600. So that's doubled. In the Midwest as well, keeps rising. Japan premiums. So I think we are seeing it. But I would say the physical realities of this are going to become clear as time goes on.
I mean, this is just the latest shock when it comes to what's going on in the Middle East. A lot of importers were also dealing with the on and off potential of what was going on with Donald Trump's tariff policies. Are you seeing more countries stockpile base metals?
So I think we're seeing more countries definitely talk about it. At the moment, we haven't seen too much in terms of what we could say extra buying. But what we see is, first of all, this started off with the US Project Vault, talking about, we need to have stockpiles, we need to make sure we've got security of supply chains. We're now seeing the EU, the UK, Australia, South Korea, everyone's starting to bring up that word stockpiling. And so I think as we've had enough supply shocks now, we had this in COVID, that definitely drove increased inventories at the company level. But this time, governments are paying attention too. So I think this is going to be a theme for the next few years that's actually going to be pretty bullish for the complex.
Yeah, how much of a premium is that adding to prices?
So I think this will probably keep your prices well above sort of, typically we would say prices should be anchored around cost support or incentive price, what you need to bring on for a new mine. But if you think about inventory building, it's essentially demand. So that allows us to trade at a premium. So for example, in copper, we would say that kind of incentive price is more like $10,000 a ton to bring on a new mine. But we forecast prices staying well above that, sort of $12,000 through the medium term, just to take into account that stockpiling.
Can we finish on gold?
Absolutely.
South of 5K. What's going to happen to demand for gold now, and how has that shifted? How has that changed? We've talked so much about this massive tailwind of central bank buying. Is that still going to be the story, or has that ended?
So I think the central bank buying has been the sort of stable level of gold demand under the surface, although what we did see in March was Turkey selling gold to underpin the lira. In contrast, though, we had China actually buying the most gold they had bought since January 2025, so a bit of a reaction to that pullback in prices. I think the bigger factor that's going to swing around is what the exchange-traded funds are doing. So last year, they bought nearly as much gold as the central banks, having bought zero the year before. So they are the ones that really swing their behaviour. That's much more dependent on interest rates. So again, they have been selling. And I think also there was quite a lot of buying that was just related to how well gold was doing. So I think the fact that it has come off, we've sort of reconnected with that real yield story as well. I think maybe that stops a bit of the near-term upside and just keeps it a little bit more to do with fundamentals.
Gold this morning, slightly positive by 0.8%. Just one final question, slightly outside of your remit, but try and indulge me. In this market, particularly in equities, they've taken a lot of comfort from the shape of the futures curve in crude. At the very front, you've got these very elevated prices. The closer you get to the physical spot price, you've got a lift in the price. Further out, you've got a massive decline. That's the backwardation people have been talking about now for weeks, 6 weeks, more than a month. People in equities see that as a market-implied bet on the future price of crude. Is that the right way of looking at things when you look at a futures curve?
Yeah, so look, I think the way we would think about the futures curve is more a reflection of inventories and flows rather than a forecast for the price. And this applies to metals as well. Typically, when you have that downward slope, spot prices higher than futures, that's telling people we need to clear everything out of inventory. We need as much oil as you can give us at the moment. So if anything, that downward slope is usually a bullish signal for commodities rather than a bearish one.
Interesting. Amy, it's good to see you. Thanks for being here. Thanks for breaking it down. Amy Gower there of Morgan Stanley on the commodity market. Brent crude and WTI just south of triple digits so far this morning and closing below triple digits for 4 consecutive sessions, just adding to some of that enthusiasm in this equity market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. NVIDIA is denying a report that it's acquiring a large company that would, quote, reshape the PC landscape. The website Semi-Accurate saying the chipmaker has been negotiating a deal for more than a year. The report sparking a rally in both Dell and HP shares. Treasury Secretary Scott Bessent saying banks may soon need to collect citizenship information from their customers. The move could make it more difficult for immigrants and some citizens to open U.S. bank accounts. Bessent saying an executive order mandating the change is in process. And a Blue Owl fund raised $400 million from bond investors, marking the first deal of its kind in over a month. The bonds were issued by Blue Owl Capital and priced to yield 6.5%, with proceeds to be used to repay existing debt. Those shares up 2%. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour in about 30 minutes' time. Up next on the programme, calculating the impact of war.
If we were going to have an extended $90, $100+ a barrel of oil month after month after month, we would have to, here in the U.S., start factoring that into our calculations. It would start spilling over.
Well, we've done month after month. We're just waiting for the next month, I guess. You know, it's adding up. Son of Desai, Franklin Templeton joins us next from New York City. You're watching Bloomberg TV. Stocks up again, getting used to saying that. Up another 0.2% on the S&P, up 0.4% on the Nasdaq. Lots to talk about in the bond market as well, so let's do it. In fixed income stateside, yields just about unchanged on a 10-year at 4.29. Things haven't been unchanged over the last month. We talked about it in the last hour. The move high you've seen in UK yields through the month of March up by close to 70 basis points, levels we haven't seen since 2008. Well, the buyers have stepped in. With those levels, the Debt Management Office in the UK just issued £15 billion of 10-year bonds at a yield of just a little over 4.91%, the highest since 2008.
So the good news for the United Kingdom is they had a record volume of investor demand coming in to buy said debt offering. Yay! That was the headline earlier today. A little bit of a problem, though, when you take a look at what kind of premium they have to pay up to get that interest, which again goes back to the core question we keep asking. How much fiscal headroom do a lot of these nations have to meet any softness in the economic outlook based on higher energy prices, higher inflation?
And also another dimension, and we talked about it briefly, the degree of demand that will step in. Now we've backed up to these levels. We saw it in Japan, the highest yield since the 1990s through the month of March into April. In the UK since 2008. In Germany, I think, since 2011. And this is why bond investors are seeing this as an opportunity. Now, whether it's the right opportunity, I don't know, not for me to say, but we've heard that repeatedly over the last month, that with this backup in yields, the buyers would step in.
If somebody wants a relatively risk-free, although you can make that argument, a relatively risk-free portfolio at 5%, well, if you don't have to lever it up, it looks pretty good, especially based on where we were, say, 6, 7, 8 years ago.
The latest out of the bond market so far this morning, under surveillance this morning, calculating the impact of war.
A lot of it just depends how long does this go. If we were going to have an extended $90, $100+ a barrel of oil month after month after month, we would have to, here in the U.S. start factoring that into our calculations. It would start spilling over. It'd first go into airlines, anybody who has to drive, and then it would probably pretty quickly start getting into food pricing.
So here's the latest this morning. The Federal Reserve weighing the impact of increasing fuel costs with fresh inflation data due out in less than an hour's time. Sonal Desai of Franklin Templeton writing the Fed will stay on hold. It's too early to panic about the damage that high energy prices will do to growth. Sonal joins us now for more. Sonal, welcome to the programme. I've got to ask you the question. What kind of damage, if any, do you expect from the higher prices we've seen so far?
So the prices, hi Johnston, thanks for having me. The price increases we've seen so far in real terms are still 20-25% below what we saw in 2022. What damage did they do? No, I mean, clearly on the margin, having $4 a gallon gas prices is problematic. But you have to remember, since 2019, we've had 27-28% inflation. So in real terms, $4 today just doesn't mean what $4 even 4 years ago meant, let alone $4, say, 2007-8.
Is that an argument, Sonal, for higher yields from here?
Yeah. So I would say that as far as yields are concerned, I do think that this at 430, this isn't a buying opportunity. I think we are for the US. I hear what you're saying about the UK and parts of Europe. I think that there will be more significant damage over there to GDP growth, and potentially you do have opportunities. However, in the US, I think there is scope for inflation to go higher because there's scope still to get that famous tailwind from consumption that we've been waiting for from the tax refunds. In addition, I think that the budget deficit could go higher, as we start seeing more defense spending. At some point, we'll have to see that. It's hard to say that it's all going to happen this year, but over time, just restocking our military implies a higher budget deficit, unless they cut expenditure, which nobody seems to have any desire to do.
So now it seems like heading into this year, people were looking for a yield curve steepener. Then it suddenly became a yield curve flattener. You saw the flattest yield curve going back to 2022 at the end of last month. Now people are gaming out what you're talking about, a Fed that might remain on hold or even cut rates, even as inflationary pressures remain. How much do you expect the yield curve to steepen over the next, say, 6 months?
So since I don't expect the Fed to cut, and I do think long-end yields are probably going to go up, I think that the yield curve can steepen. How far can the long end go? Depending on, I hate saying this, but depending on how long the war lasts, that has inflationary consequences eventually, and it also has certain implications as far as the budget deficit is concerned. So I'd say, could you see 25 basis points more? 30 basis points more of yield curve steepening from here on? Yes, and even more if markets start pricing out rate cuts.
At what point do government bond yields start crowding out some of the corporate bond issuance, given the fact that the United States and other countries are going to have to sell debt to raise money to pay for some of the expenditures that you were talking about? And given the fact that right now we're seeing a record amount of corporate bond offerings come to market?
Lisa, we are awash in liquidity. If I look at how much we have in the short end in cash and liquidity in the ultra short parts of the bond market, I think we still have an overhang of liquidity from close to soon 20 years of massive QE, which has never significantly been reined in, and budget deficits. They're just awash in liquidity. I don't see that crowding out happening. I mean, rates will be higher, and I think we will see interest in the bond market.
So now, when you look at a higher budget deficit in the United States because the restocking of the military and a higher defense budget, do you have to start pricing that in before the midterm elections this year? Because at minimum, likely, the Republicans are going to lose the House.
Yeah. No, I think that the question of how that deficit increases and the timing of it, I think some of it probably does start showing up as we get closer to midterms. For one thing, we probably won't see the tariff revenues, which were never really budgeted, coming in quite as strongly as was anticipated, given the changes which are in place as far as tariffs are concerned. There are a variety of reasons to anticipate the ex-post budget deficit is going to be somewhat higher than the ex-ante one, despite the fact that higher inflation does lead to higher budget revenues mechanically. That happens.
When it comes to tariffs, doesn't the U.S. government have another bill to pay, the refunds?
Well, the bill to pay and the refunds, is it going to take years or is it going to take months? I really don't know, because I have no idea how quickly that will be done or how the logistics of it are actually going to be solved. And nobody's really been able to give me clarity on what the logistics of tariff refunds, how it's going to actually play out.
So, no, if I was in line to be the Fed chair, I'm not. If I was, I'd be delaying processing my paperwork because I'd have nothing to do with what's going to happen this summer. How messy, I'm not implying anything, how messy is communication going to be later this summer?
Actually, Jonathan, I think that communication would be rather easy because I think that inflation will probably help any incoming Fed chairman by showing up high. You don't cut rates into that. I did hear there's still a big expectation that somehow rates will be cut because Wolfe is coming in and Trump has given him the job. But if inflation picks up, and again, it shows up. Inflation, when we see fuel prices go up, it will show up in inflation. It's a separate question as to whether it's enough to actually have a very detrimental impact on consumption. However, it's going to show up in inflation, and I'm not anticipating a massive slowdown in the labor market. So you put those two together, communication is actually not complicated at all.
Would make it complicated for a man that was employed to cut interest rates, but that, I guess, is a different story. So, it's good to see you. It's good to see you, as always. So, Desai there of Franklin Templeton on the future of the Federal Reserve and this bond market. Check out this move. American Airlines in the pre-market. This market's shown that report by us a lot of respect. Stock is up by 9% in the pre-market. That report, if you're just joining us, United Airlines CEO Scott Kirby exploring the potential of tying up with American Airlines. American Airlines up in a pre-market by close to 9%.
Yeah, and United shares also up in pre-market trading. The market is saying, please, this looks like a great deal. Whether or not regulators think the same, highly unlikely, although we shall see, because evidently Scott Kirby talked directly with President Trump about this. Heading into higher oil prices, we're getting reports that the European Union is preparing for shortages in jet fuel in the very near future. How much better of a hand do the strongest players have? They have an incredible upper hand when it comes to maneuvering through this. And Scott Kirby wants to take advantage of that with acquisitions.
It would be a big hurdle to clear for the DOJ and for the Department of Transportation to allow this merger to go through. But this isn't the Biden era where you can't have a Coach handbag tie-up. So potentially there is some runway for a sort of airline deal. And maybe to your point, they're anchoring to the extreme. It's not this one, but this is where they're going to set the debate around. And then say, OK, if you think that's too big and just too many problems for antitrust.
How about JetBlue?
Yeah, how about something smaller?
How about that? America right now, up by 8 to 9%. Can you imagine if that did go through? What that would open up, not just in that industry, but in other industries. Other players who would look at the competition.
Google and Amazon?
My goodness. Beyond that.
It'd be crazy.
Just crazy. Coming up in the next hour, Joe Cassidy of RBC, Alicia Levine of BNY, the Port of LA Executive Director Gene Seroka, and Stephanie Roth of Wolfe Research. The third hour of Bloomberg Surveillance is just around the corner.
It's going to be a lot of stress on the market.
Investors always hit the sidelines when you have uncertainty.
It's risky not to take risks.
The market is being very calm about this whole situation.
There's a lot of other themes that people are going to have to sort of roll their sleeves up on again.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures pushing higher by 0.25% on the S&P 500. On the NASDAQ, up by 0.5 on the NASDAQ. A 9-day winning streak. In the commodity market, Brent and WTI pulling back. WTI this morning down by 2%. Brent down by 0.8%. 98 on Brent. 96 on WTI. This headline just crossing the Bloomberg terminal. Iran mulling pausing its Hormuz shipping to avoid derailing talks.
Yeah, this according to a person familiar with the Tehran's deliberations, as reported by Bloomberg News, saying that this maybe signifies this desire to keep talks on the rails to avoid escalation in any form as they continue to have ongoing face-to-face negotiations. A real question here about uranium enrichment as well as reopening the Strait of Hormuz. Not open yet, nonetheless, not escalating the conflict further.
Well, exactly. This says to me that Tehran wants to have these talks, potentially, as Reuters reporting this weekend. We reported that talks are potentially underway, but as soon as maybe Friday and Saturday and Sunday. So basically what they are going to do is hold back on any sort of maritime activity to make sure that there isn't an escalation. So keep things at this moment, the status quo, so the ceasefire holds. That, at this moment, would be viewed as a very pragmatic step for this regime.
That is contributing to the reset we've seen in this equity market, wiping out the losses since the start of the war. The S&P 500 coming into this morning, positive for the year. Supporting that maybe some bank earnings. And the bank earnings so far have been very, very mixed. From JPMorgan, from Goldman Sachs, Citi just crossing moments ago. Citi crossing seconds ago.
Yeah, and coming out with a beat for fixed income currencies and commodity sales and trading, coming in at almost $2 billion versus the estimate of $5.02 billion. Equity sales and trading coming in at $2.08 billion versus the estimate of $1.73 billion. Pretty much across the board, there was a slight miss on the banking side. The CEO, Jane Fraser, coming out and saying services had an outstanding quarter. You're hearing that there is this ongoing right sizing of Citigroup and that the bank is entering into its final phase of divestitures. But the real takeaway here, capital markets very strong. Expectations were very high. For the most part, most banks are clearing those hurdles. The response in markets, though, has been a little bit more differentiated.
This is the early move in the pre-market. The stock is a little bit higher by more than 1%. Danny Berger's pouring through those numbers. We'll get to Danny in just a moment. To set up the next 60 minutes, we'll catch up with Levine of BNY Wealth following a morning of bank earnings. The Port of LA Executive Director Gene Seroka joins us as war in Iran weighs on global supply chains. And Stephanie Roth of Wolfe Research breaking down the latest inflation data. The latest earnings then, to wrap them up, we've heard from JPMorgan this morning, from Wells Fargo and Citi just moments ago. Danny has more. Hey, Danny.
Hey, John. And the story is trading very, very strong for Citi, posting $5.2 billion of trading for FIC. That comes just under the high watermark of a record they set in 2020 during COVID, but easily above expectations. Their equity business, which, keep in mind, this is much smaller for Citi, posts a record sum, $2.1 billion of trading. The estimate was for $1.7 billion. This is the first time in Citi history that we have an equity trading figure that's above $2 billion. Lisa did mention this. There is some disappointment coming around their banking revenue. That comes in at just over $1.7 billion. The estimate was for 2.1. But the big takeaways and the reason you are seeing positivity for Citi, this was the highest quarterly revenue in about a decade for Citi, the best return on tangible common equity in 5 years from Citi. And Jane Fraser and the team go on to explain that they are 90% of the way to completing their programs around their back office, their regulatory reporting issues, something that they had really been hit through. So it's this transformation of Citi that Jane Fraser has been undertaking as CEO, and they are getting closer and closer to completing that. In the meantime, notching very strong numbers for trading.
Danny, great coverage this morning. We've seen those strong numbers for trading at JPMorgan as well. Citi up by 2% in the pre-market. Jared Cassidy of RBC is back with us for more. Jared, you had an outperform on JPMorgan, an outperform on Wells Fargo, an outperform on Citi. Let's just sit on Citi. The revamp under Jane Fraser, how impressed have you been so far?
John, very impressive. As you can see from today's numbers, the return on tangible common equity was lifted up to about 13%, as it was just pointed out on your program. This is one of the better numbers we've seen in quite some time, and she's done a very good job in divesting the unprofitable non-U.S. consumer businesses. The last one up is, of course, the IPO for the Mexican subsidiary. They have the anchor investors, so we should see that this year. They have their big investor day coming up in May, John, and I think you're going to hear a lot of positive commentary about the outlook for Citi at that investor day.
I was struck by the commentary that we heard from Jane Fraser, in addition to the positivity that you're expressing and that the results most broadly did seem to demonstrate. She said, we're off to an exceptionally strong start in 2026. How do you pair that with concerns about what's going on with the Middle East, with some of the sort of warning discussions we heard from the CEOs of Goldman Sachs, JPMorgan, and beyond?
Lisa, it's a good point because, the first quarter was a tale of two quarters. When you think about coming into the year, up until the end of February, the quarter was very strong in many of the different areas for Citi and its peers. Then the breakout of hostilities at the end of February increased that volatility, particularly in the capital markets area. So there is still a lot of uncertainty out there, but should the hostilities in the Middle East start to die down and we get this resolved sometime in the second quarter, that points to a very healthy second half of the year for the banks like Citigroup.
You were talking about what's left in terms of the revamp. Jane Fraser said that the bank was about 90% of the way to completing the programs it established to fix back office and regulatory reporting problems as pegged by regulators a number of years ago. How different is the bank today than, say, 5 years ago? And how does that sort of set us up in the current environment?
I think it's very different, Lisa, because obviously you've had a change in leadership compared to 5 years ago. And I think that this leadership, led by Jane Fraser, is very focused on delivering the numbers and holds people accountable within the organization. And that's probably one of the biggest differences. And it's showing up on the bottom line. And so once they finish the complete revamp, as you point out, it's 90% completed. Once they finish it, then it's going to pivot from not a turnaround story, but to now it's a growth story. And this first quarter results really gives them a good jump on that growth story.
Gerard, we know you're super busy this morning, so thanks for making some time for us. Gerard Cassidy there of RBC, breaking down the results from Citi. Citi up on the year by about 8% coming into today, up again this morning by 1.6%. For stocks more broadly, finding a firmer footing of late, with the big banks kicking off first quarter earnings season. Alicia Levine of BNY Wealth joins us now for more. Alicia, good morning. Good to see you.
Good morning.
This market's moved on from events in the Middle East. Do you agree with the direction of travel?
So we do agree with the direction of travel. We obviously remained concerned, but not willing to change our allocations because we felt that ultimately the damage that would be imposed by $120 oil for a long time would not allow this war to continue much longer. And so as a result, we came into this with a pretty strong economy, a good setup with fiscal support, all the refunds coming from the IRS this season right now, the labor market looking like it was turning a little bit. And so you have all the incentives on the corporate side for investing. And so when you put it all together, the view that perhaps the U.S. could have grown at 3% or more this year was the narrative coming into the war. And so maybe you shave some growth off of that. But ultimately, with earnings expectations at double digits, on March 1st, now 3% higher than they were, you have a situation where the fundamentals actually got stronger, even as we worry about inflation and as we worry about where this conflict could go on the left tail.
It's difficult to get your head around that over the last 6 weeks, given everything that's happened, the outlook for earnings actually improved. It didn't deteriorate.
It did not deteriorate. It's really shocking. When we tell clients, look, earnings expectations are actually higher than they were January 1st. It's not just driven by energy. I mean, that's the obvious one, that energy earnings are now positive. They were expected to be negative, but materials and the tech sector. So, the great partner to the S&P forward motion is tech earnings, and it's just, they moved higher. The expectations moved higher. So the other thing that happened or didn't happen is that there have been no downgrades at all. And so that's the thing to keep a look at. We're in the beginning of earnings season. You have to see, are input costs higher? Do we have to shave revenue on the expectations? Because that's what didn't happen. We haven't heard anybody bring earnings estimates down. So that's really the tension here. We're now at 15% expected earnings growth for 2026. Is it realistic? Because the margins are the highest too. I'm not sure that's so realistic, and that's where we would look for any kind of moderating force on this.
So it's been a storm. It's been a month-long storm. It's been a 46-day storm and a real question of what has changed fundamentally in the outlook going forward as a result of the Iran war. A number of people have pointed to leadership. To your point, the gains have come in profit expectations at big tech, at materials, not necessarily consumer discretionary. How much is this back to where we were at the same time last year when tech just reclaimed its leadership?
Look, we had this conversation a few months ago where I said, look, I think tech can actually move higher into the rest of the year. Everybody's selling software. They're getting out of tech, getting rid of the queues because they see more interesting opportunities in international and more traditional, I call it the dirty industry. So materials and energy and utilities. And in the end, tech has actually done quite well since March 1st because the earnings power are there. And if you're worried about growth and you're worried about inflation, you flee to tech. And I think there's a little bit now of a two-way conversation. Like, are you being paid to take a risk in this sector? And I think the answer is yes.
The other thing that people were talking about earlier this year is the broadening out away from the United States to the rest of the world. We had BlackRock, Jean-Bovin, come on and say that he liked emerging markets. We had the same kind of commentary earlier this morning from Brian Levitt of Oppenheimer. How much do you expect the dollar to revert back to a weakening trend to allow that type of broadening out geographically?
So I think one of the most shocking things that's happened during the war is the fact that the dollar has not strengthened more. The dollar is essentially 1% higher than it was March 1st. One would have expected that the dollar would have strengthened much more based on the concern of the risk. So then what you have to say is, look, if this is simply a crisis-induced strength in the dollar and ultimately it means there's downward pressure on the dollar, ex-U.S. markets will do quite well. And I think we're in that place where we never thought the dollar was going to collapse this year the way many folks did. But it does seem that it should have been stronger than it was, and it wasn't. So I'd say rest of world looks okay. If you are worried at all about tail risk, then emerging markets and developed international are going to be the areas where you feel it first. You spoke about the bond yields here on the show earlier this morning. Global bond yields have sold off much more than in the U.S., and that is a concern. So I think you'd a little bit have to be careful about is this a trade or is this an allocation for the next 12 months? For the next 12 months, I still prefer to be in the U.S.
Within the U.S., you like industrials?
I do.
Can you just tell us why?
Because you have incentives for, first of all, I think you have to think about this. What's driving the growth here? The AI build-out is remarkable. What's happened to some of these energy providers and industrials is remarkable. You have stocks up 40 to 50% year to date, and that's because there are massive incentives to build from the tax code, but also the end user demand is there. And that story is still intact. That's why PMIs are positive. That's why, the ex-housing manufacturing is positive because you are having this forward push. What got lost in this conversation is that we're really undergoing an industrial revolution. So we've all become geopolitical strategists for a month, but actually the AI forward push is moving forward. And so we see the reshoring theme and the AI build-out theme as enduring for the next 2 years.
We've certainly seen that in the ISM. Some decent momentum in that data. Alicia, it's good to see you.
Great to see you.
Alicia Levine of BNY Wealth. Constructive and has been throughout this war. And we should give people a nod, tip our hats to the people who have been constructive throughout this war because there was a lot of risk out there and this market has reset big time. There's still a lot of risk out there, but this market's basically done a round trip.
And pretty much everyone who has remained bullish has pointed to earnings and earnings expectations that have risen during this period of turmoil. And we haven't seen guidance materially lowered. And I mean materially from where they were earlier.
We haven't seen the cuts, to Alicia's point.
Yeah.
We haven't seen the cuts. Now, are analysts just too slow? They're waiting for the management teams over the next months to do the work for them?
It seems like the actual management teams haven't been guiding them that way either, because you heard from the airlines saying that they're going to maintain guidance even with the potential hit from oil prices. So a real question about whether growth was just expected to be so much higher. And so now the actual outlook is pretty much the same as it was earlier.
Adding to gains this morning, we're up by 0.25% on the S&P with an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Taking another look at Citi, we are seeing shares up 1.3% after the bank posted a beat on revenue and profits. Citi saw $5.2 billion in fixed sales coming in above estimates, while equities trading crossed the $2 billion mark, pushing the bank to its highest quarterly revenue in a decade. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And we are seeing shares of Globalstar rising 9% in the pre-market. Amazon agreeing to buy the satellite operator for $90 a share. Amazon is aiming to compete with Elon Musk's SpaceX and its Starlink network. The deal is expected to close next year. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Bit of an update as well on Kevin Walsh. We talked about that in the past 10 minutes or so. Is a hearing underway? Coming up soon.
That's according to Tim Scott, who, of course, is the chairman of the banking committee. So it's important what he says. And he says he's cleared all the hurdles. And now we will go to have a hearing for Kevin Walsh next week.
The latest details from Senator Scott so far this morning. Up next, we'll get you some morning calls. Plus, we'll catch up with the Port of LA Executive Director Gene Seroka as the war in Iran weighs on global supply chains. That's next from New York City this morning. Good morning.
CENTCOM has been charged to stop these vessels. It's not clear that they have a guidance about what to do with them after the fact. This is really a point of leverage that the U.S. government is trying to impose on both Iran and China. The U.S. government's view that this could be just a couple more weeks of pain, the timelines might not line up, in my view.
That was Rachel Ziemba of the Center for New American Security weighing in on the situation a little bit earlier. Your equity market update looks like this. We're positive by 0.3% on the S&P, up by 0.5 on the NASDAQ. In the commodity market, Brent and WTI trading softer this morning. WTI is down by close to 3%. Brent's down by 1.3, 98 and 96 respectively. That's the price action. Let's get you some morning calls. First up, Bank of America lowering its price target on Goldman to $10.50 after it reported earnings, seeing results that are likely to give investors pause. Your second call from UBS upgrading Tesla to neutral, believing shares are currently at a more reasonable level following the sell-off. And finally, Citi raising its price target on Alphabet to $405, believing its first quarter results are likely to beat expectations. That name is up in a pre-market by more than 1%. Let's turn back to trade. The war in Iran weighing on shipping as the U.S. blockade of the Strait of Hormuz enters day 2. The Port of Los Angeles Executive Director Gene Seroka writing, it will take months to untangle global supply chains. The economic ripple effects are real. They are growing. Gene joins us now for more. Gene, a good friend of this show, and thanks for making time for us this morning, sir. Let's start with the economic effects, the ripples you're seeing. Where do they start? How have they started, and where are they going from here?
Good morning, John. An adage in our port industry is that for every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Now, there may be some fits and starts and some quick answers that could be delivered, but once the strait is open, there is a lot of work to do in this supply chain. We're seeing right now where vessel fuel prices have doubled over the last month and a half, and that carry-on effect to importers and exporters right here in the U.S. is happening today. They probably will simply pass on these costs to the American consumer and buyer.
So, Gene, fuel costs are going up. The length and duration of the trips is getting longer because they've had to reroute a lot of this stuff. We've seen diversions pop up in different places as well. From your perspective, are you expecting congestion as well? How lumpy are some of these arrivals going to be, and how complicated does that make life for you?
Each trade, John, is a little bit different. For now, the 46th day, you're not seeing a lot of traffic move from Asia to the Arabian Gulf. Red Sea and East Africa also disrupted. In the Trans-Pacific trade, the ship transits are fairly normal. We're seeing the regular departures and arrivals from Asia, but it's the ports that we share with those Middle East destinations that are becoming somewhat worrisome. Singapore, Kaohsiung, Shanghai, Korea, and then Japan ports. If this cargo continues to pile up at these locations, it may just simply get in the way of cargo that's more fluid, like that coming to and from the United States. I must say, though, with calls over the weekend and last night, the Asia ports are doing a fantastic job of keeping that cargo separated, so the fluidity of the trades that continue to move remains intact.
Gene, when you see individuals having to change basically some of their supply chain routes because of what is going on, do you see any of this sticking even if the strait opens? We have a little bit more of structural changes going forward.
Annmarie, this is always an outcome of disruption. Once cargo finds its way to a cleaner or smoother path, it tends to stay in that way for some time. We've had troubles over the past years with drought conditions in the Panama Canal, the Red Sea security issues leading to drops in Suez crossings by up to 80%. More cargo now moving towards the west coast of the United States in that trans-Pacific trade, where previously it had alternative routes and those that were quite lucrative for shippers going through those canals. More than likely, what we'll see is a reset at some point, because that consuming public in the Middle East is very strong. Albeit only 10% of worldwide container trade, the buying power for furniture, footwear, perishable commodities, and other retail goods will continue to be a primary market for those serving the Middle East.
I know there will be a delay even when the strait opens, but we haven't even seen the Red Sea get back to normal levels, given what took place in the previous years with the Houthis. When do you think the Strait of Hormuz will actually get back to normal levels after there is a more lasting ceasefire?
That's the biggest question. And I don't think it's going to be a straight line, Annmarie. One day we're going to get a message that says all clear. I think this is going to be an iterative process. We're hoping that both sides can get back to the negotiating table to find a way towards some semblance of a truce, and then start having a conversation about the commercial implications and how we restart this engine. Right now, this blockade is for negotiating purposes to try to put some pressure on the system, and especially with the price of oil over $100 a barrel, this is a huge revenue pop for some, and it could be a tremendous cost implication for those that can't get their oil and energy products to market. Probably at the same time, there's some minesweeping going on in preparation for the day. We can see that strait open up a little bit. But when we've gone from basically 110 ships a day down to just a trickle, it will take some time to get these products moving in and out.
We're all hoping for the best, Gene. Appreciate your time. You're a gentleman. Thank you. The Port of Los Angeles Executive Director, Gene Seroka, on the situation, the congestion at certain ports in Asia and the workarounds those guys have been playing up and trying to work through over the last 6 weeks.
Yeah, a lot of this really goes down to a fundamental question that a lot of people are asking, which is how much is the concept of free passageway on the seas truly in jeopardy or becoming obsolete? And how much does this set a precedent for that versus, say, some of the previous conflicts and what's happened there? And that's really going to be crucial to a lot of the supply chains.
Things have got messy very quickly. Up next on the programme, we'll talk about the data, PPI data set to cross. We'll get reaction from Stephanie Roth of Wolfe Research. She's with us to break it down. Plus, the latest from the earnings call with JPMorgan's Jamie Dimon and some comments on there on Kevin Walsh. That conversation up next. Another read on inflation data in just a moment. PPI is just around the corner, seconds away. Mike McKee will break it down for you in just a moment. The scores heading into that. Equity futures positive by a third of 1%, 1 hour away from the opening bell. We're up 0.6 on the NASDAQ. On the NASDAQ 100, a 9-day winning streak, and it could be 10-day. Phenomenal. Could be a 10-day winning streak on the NASDAQ 100. In the bond market, we're set up as follows. Yields on 10s just about unchanged throughout much of this morning. Let's call it 4:30. With your economic data, Mike McKee has more. Hey, Mike.
Good morning, John. It's a little bit better news than anticipated. PPI on a headline basis up just 0.5%. The expectation was for 1.1%. On a year-over-year basis, that puts us at 4% from 3.4. The expectation was we'd hit 4.6%. The core up just 0.1%. the forecast was for 0.4. Last month it was 0.5, and that puts the year over year for that at 3.8%. The core ex-food, energy, and trade is up 3.6%. That's a tick up from the last time. In the March rise for final demand prices, 1.6% advance in the index for final demand goods. Prices for final demand services were unchanged. And what's interesting about that is that final demand services were the issue in last month's big rise in terms of what happened. The one thing I want to check here is what happened with the services prices that we anticipated would go up. And that's the main issue here for airline fares and things like that. It doesn't look like that's immediately going to come up. So I'm going to leave that for you guys. But airline fares were supposed to go up. Gasoline prices, of course, going up significantly, and those are major issues. I want to leave you with one other thought, and that is that you have reported that the senator from South Carolina, Tim Scott, who's the chairman of the Banking Committee, says that that Kevin Warsh, the Fed chair designate, will have a hearing next week. I'd point out that on Tuesday, the 21st, Christopher Waller, the Fed governor who was considered for the chairmanship, is giving remarks on how he would change the Fed in the future. It'd be very interesting if the two of them end up on the same day.
Mike McKee, thank you, sir. Appreciate the update. Mike McKee breaking down the PPI data and the future of the Federal Reserve. Just an update on the future of the Federal Reserve. This from Punchbowl just moments ago. The Kevin Warsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. According to multiple sources with knowledge of the plans, the Senate Banking Committee is planning to notice the hearing later on today with just a month or so left on Jay Powell's term. So things are moving forward slowly, but moving forward.
Yeah, so he has this hearing. The question is, does the Jay Powell probe get dropped so then Senator Thom Tillis can then vote for Kevin Warsh to get through the hearing and then have a full vote, not in the committee, but actually on the Senate floor? That is going to be the key question, because Kevin Warsh getting a hearing, okay, great, that moves it forward slightly, but unless Thom Tillis decides he's going to vote for it, he could just be stuck in this committee. And we don't know if Thom Tillis is going to vote for it until we know what goes on with the DOJ probe on Jay Powell.
In addition to that, we don't know what Chairman Powell himself will do with regards to his future.
Yeah, whether he'll stay on as a governor even after his term as Fed chair is up. He said he will make that determination at a later point. Unclear what the characters are going into that. Nonetheless, it's even less clear to know what exactly the Fed is going to do with the panoply of potential data as well as events that are coming down the pike. Kevin Warsh might want to hang tight before he has to make the argument to cut rates, given the fact that there's a lot of dissent on the committee and some real pressure coming from the White House.
So we've got two things to do here. We need to talk about the future of the Federal Reserve. We need to start on the economic data. PPI softer than expected. Push that through the bond market. No big moves here. The US 10-year yield is unchanged so far. In the equity market, still positive by about a third, call it a quarter of 1% higher on the S&P 500. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning. Good to see you.
Good to see you.
Your reaction to that data for the month of March?
Yeah, so the details that matter for core PCE is really what we're looking at for. Airlines were up similar to CPI, 2.8. Physician services were kind of light. Finance wasn't too strong. So our tracking for core PCE for March should look, in the 0.2% range. So when we're thinking ahead, the question, though, is are airline fares going to start increasing more materially in the upcoming months? And that's when it's going to become a bigger question. And I think that's what the market kind of told you after CPI is, yeah, OK, we get that the March data were OK, but what happens in the months after that? And that kind of fits with our move that we made somewhat recently, pushing out our Fed cuts from previously 2 cuts this year to now 1, and then we added 1 cut into 27.
What's your base case for inflation? What's the trajectory of things through the summer and into the fall?
Base case is that you'll stay around 3%. We think you'll actually end the year at 3.1, but that, of course, compares to the Fed's 2.7. Our expectation is the Fed's ultimately going to have to revise that up, which then makes it a little bit more difficult for the Fed to be cutting in the next couple months.
That said, doesn't the fact that you're getting less inflationary pressure heading into this period a positive with respect to the Fed's ability to cut rates? I mean, doesn't it sort of take off the table the idea that inflation was heating up in a dramatic way that would force a lot of these producers to raise prices for consumers?
It's certainly a positive sign, but then again, your February core PCE was 0.37, so you're kind of starting at an okay place, not amazing, and core inflation year over year is still, around 3%. So I would say it's an okay spot. It's not as if you were starting from a very low inflationary backdrop. And now you're going to have just a little bit of upward pressure in the next couple of months.
What data actually makes sense to look at right now? Because it seems like the market kind of looked past this, is looking past other factors that have come down the pike. It seems like old data, not relevant, not necessarily going to track. What are you waiting for that will give you a sign of whether we really are in an inflationary kind of upswing or not?
It's going to be the realized inflation data. Today is, another indication, but we probably need to see April and May to get a sense of whether you're really seeing the pass-through in terms of airfares. I think that's probably the cleanest component that feeds into core inflation that is directly tied to the energy shock. So if we don't see stronger airline fares in the next couple of months, I think might feel better about the pass-through. Of course, then that tells you maybe there's a problem for airlines to be able to pass through those costs. But that tells you the inflationary backdrop certainly looks different than 2022.
Need to talk about the future of the Federal Reserve as well. Kevin Walsh making an appearance on the JPMorgan call with Jamie Dimon, not literally, but his name was mentioned. Danny Berger was tracking that. Danny joins us now. Hey, Danny.
Hey, John. I have to say it was extremely brief, Jamie Dimon's comments around this. Basically, a journalist asked, Mr. Dimon, how do you feel about delays to the nomination of Kevin Walsh? And I have to say this question was asked right before Punchbowl reporting the impending maybe process coming forward. And Jamie Dimon said simply, Kevin, I guess they're on a first-name basis, Kevin is a great candidate. The sooner, the better. And then he ended it there. He also goes on to talk a lot about economic confidence he has despite the war and despite some of the uncertainty going forward, but a very confident Jamie Dimon on the economy and basically just saying, yep, Kevin Walsh, he'd be great, and the sooner the better.
Danny Berger with the latest. Danny, thank you. Looking forward to the programme alongside Matt Miller, kicking off in about 20 minutes' time. It makes the question around Chairman Powell's future, I think, all the more important. I've raised this question over the last month or so since the last meeting with the chairman, when he refused to say that he would leave even if the investigations went away, and even if we had a new chair appointed, he wouldn't rule out staying on as a governor of the board. He seems to be worried about central bank independence, which is curious because so many establishment figures back Kevin Walsh to lead this Federal Reserve.
There's some speculation that Fed Chair Jay Powell was trying to take back a little bit of control or at least push back from what the White House is doing. Whether he will come clear with respect to what he's going to do if Kevin Walsh is nominated remains to be seen. Right now, markets have been incredibly sanguine about the future of the Fed. It's sort of a parlor game for us and for analysts to talk about what this could look like and the lack of certainty. But the conviction in markets that this Fed will anchor inflation, I can't get over that. The fact that that has persisted, even with all of this drama, even with the questions of the politicization of the Federal Reserve, is what I keep coming back to. So I agree with you. I think that there are some real questions here. The market implications, though, I'm not seeing it, which I think is interesting.
What was so interesting about when Jay Powell did that at the podium was that he wasn't actually even asked about that question specifically. It was third on his list. He didn't even need to go there, but felt the need to say that as almost to the White House, I still hold this card. Remember, he is still being investigated in the Federal Reserve by the DOJ. And I think that was a reminder to the White House, I could still make this complicated.
An update from Punchbowl News. I mentioned it earlier. If you're just joining us, this on Kevin Walsh's confirmation hearing for Federal Reserve Chair will be next Tuesday, April 21. That according to sources with knowledge of the plans. That's according to their reporting. The Senate Banking Committee is planning to notice the hearing later on today with just a month or so left of Chairman Powell's term. Stephanie, inflation expectations. Bank of America had this note this morning, and I thought the headline was catchy, that tankers are anchored and inflation expectations are too. It's a curious moment, isn't it, that inflation expectations have been so well anchored. What's behind that?
Yeah, I mean, I think it's a combination of an expectation that it's not just about one person on the FOMC, and they have proven that they are focused on keeping inflation anchored. And it's been an FOMC over the past couple of years that has been very willing to hike rates in the face of the elevated inflation. And it's not just up to one person's view. And what we've seen so far is an energy shock that ultimately could hurt demand. It's different from where we were in 2022 when inflation expectations started to show signs of potentially becoming unanchored, because today the economy is not the same as it was. Back then, payrolls were running at 600,000. Today, they're, call it 50, 60. Unemployment rate was low and headed lower. Now it's up with, some upward pressure from AI. It's just a very different economic environment. And I genuinely believe if we were to see an oil shock that's more significant than this, we would start to see demand destruction, and the Fed will ultimately be easing as opposed to having to hike.
Based on this reporting, this hearing will take place a week today. What is the argument that Kevin Walsh can make for lowering interest rates at the Federal Reserve? Given everything you've just said, what do you think the argument will be that he'll present?
I think it's going to be all about productivity and AI, and a backdrop where AI is disinflationary, and ultimately that will mean neutral rates are lower in the medium term. And that was the view that the market had held before the Iran shock really hit. And it's his sort of best argument, especially in the face of where inflation is today, where the economy is, and the sort of the potential direction of travel. If you do really have a strong productivity cycle, you don't usually have inflation problems at the same time.
It's incredible how little expectations for earnings in this economy have changed over the last 6 weeks, given this major shock we've seen in the Middle East.
Even from some of the most exposed sectors. And what you're hearing is maintaining, even on the margins, upgrading. Again, how much does this go back to how much momentum there actually was in the U.S. economy ahead of this war in Iran, and how the upside was the potential surprise? Now we're sort of getting back to the expectations maybe at the start of the year.
Stephanie, good to see you. Thanks for being here. Stephanie Roth there of Wolfe Research. Equity still positive by 0.3% on the S&P, with an update on stories worldwide. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. Recapping the data we just got, producer prices rising 5% in March. It's less than the 1.1% that was estimated, but follows a 0.7% rise in February. Companies are navigating a surge in energy costs tied to the Iran war. Stripping out food and energy, producer prices rising just 0.1% in the month. Iran is considering pausing shipments through the Strait of Hormuz to avoid testing a U.S. blockade. Sources telling us here at Bloomberg that Iran could be aiming to avoid an immediate escalation and derailing peace talks. The U.S. and Iran are reportedly sorting out logistics for a second face-to-face meeting. And Kevin Walsh's confirmation hearing to be the next Fed chair is reportedly scheduled for next Tuesday. Walsh clearing a key hurdle. Senator Tim Scott saying Senator Thom Tillis is now planning to support Walsh. That's your Bloomberg brief. John.
Yahara, thank you. Thank you for the update. Up next on the program, we'll catch up with Eric Freedman of Northern Trust Wealth Management, with stocks trading very close to record highs. Plus, Yahara's back with your morning movers. Amazon shares rising in the pre-market on its latest acquisition. That story up next.
For every 1 day of service disruption, it takes about 3 days to catch up. Now we're looking at about 4.5 months with respect to the Strait of Hormuz to get all these ships, container, tanker, bulk, back into normal rotations. Once the strait is open, there is a lot of work to do in the supply chain.
Real physical disruption. This market's looking through it. That was the Port of Los Angeles Executive Director, Gene Seroka. This market, the gains continue. Up 0.25% on the S&P 500. The run continues on the NASDAQ. 9-day winning streak on the NASDAQ 100, the longest since September 25. You make it day 10, the longest since November 2021. The NASDAQ this morning up by 0.5%. Let's get you some morning movers. Yahara has more. Hey, Yahara.
Hi, John. One of the biggest airline deals ever could be on the table. We're reporting that United CEO Scott Kirby has floated the idea of a potential merger with American, that he's talked to senior government officials about this. So you are seeing American up 8.5% in the pre-market, even though any deal would, of course, face intense antitrust scrutiny. And it's official, Amazon agreeing to buy the satellite firm Globalstar in an $11.6 billion deal as it tries to compete with SpaceX and its massive Starlink network. So you are seeing shares of Globalstar up 11% in the pre-market. The deal is expected to close next year. And we end on Lucid Motors. Those shares up nearly 5% in the pre-market as the struggling EV maker tries to reset, naming a new CEO and locking in $750 million from its biggest backers. Uber, and Saudi Arabia's public investment fund. John?
Yahara, thank you. Great work this morning. As always, appreciate it. As we count you down to the up and about, some things to look out for the next 24, 48 hours or so. Coming up tomorrow, results from Bank of America and Morgan Stanley, plus the Fed's Beige Book, another read on how they're thinking about the situation in the global economy. On Thursday, another round of jobless claims and more earnings for you. Netflix results just around the corner. The run we've seen in some of these tech names, phenomenal. 9-day winning streak on the NASDAQ. We're looking at day 10. Eric Freedman of Northern Trust writing the following: we do not expect the Iran conflict to severely impact the corporate profit cycle or credit markets. We remain overweight risk assets relative to bonds. Eric joins us now for more. Eric, welcome to the program. I have lost count of how many times I've asked this question of an equity market bull. What is anchoring that view, given the turbulence we're seeing play out in the Middle East?
I think the biggest things, Jonathan, are twofold. Number one, we still think consumers will remain resilient, not necessarily lower income consumers, but middle income as well as upper income consumers. Those have really been resilient. We think that continues. Also think that CapEx is still a variable that will be durable as well. So those are the two variables that we're probably domestically most bullish about. But I would say part of our opinion has changed with respect to the non-U.S. equity picture. We came into the year a little more excited about things like Japanese reflation, European deficit spending. Those may get somewhat crowded out by how challenged those regions in particular will be to the energy issue. So I think if anything, Jonathan, we're still bullish, maybe a little more of a relative value opportunity set we're seeing right now. But again, we think CapEx as well as consumer durability in the U.S. likely remains the case.
Eric, can you just stay on that? The vulnerability of what's happening internationally, because the key trades for many at the start of the year, Japan took off, that continued. South Korea just exploded higher. Are those stories under threat, even though they have some connection, particularly the Kospi in South Korea, with the developments in tech in the U.S.?
Yeah, I think that's well put, Jonathan. If you look particularly at the issues with, for example, helium and the various parts of the hydrocarbon cycle that play into technology, those aren't going away. In fact, those have gotten worse. And so, part of the issue is will there be some sort of redirection of both trade as well as will there be some new winners within the technology space that are maybe not as affected within some of those shortages. So, again, we have to respect that the direction of travel is a bit different with respect to both technology as well as what may be playing out across some parts of the consumer cycle, in particularly in Europe. That's a significant issue that may be different.
Eric, from February 27th till today, what's changed in your portfolio?
Yeah, the biggest things, Lisa, one is that we've shrunk tracking error, which is a long-winded way of saying that, hey, when the world changes quite a bit, we shrink our exposures, meaning we had a somewhat outside view in terms of an overweight for our tactical clients within non-U.S. equities. We've actually shrunk that. We've retained our bias within real assets. So the biggest thing that we've done is really shrunk that exposure with respect to the non-U.S. equity portion of our portfolio, and we've been more emphasizing the real asset side. That's been something that's been consistent, and we'll probably keep that on for some time.
And now the fun starts where we actually get earnings. We get to hear from different companies. The banks have been first, and JPMorgan came out earlier this morning on the call with analysts. The CFO said consumer spending growth is outpacing last year, talking about how engagement and pipelines remain healthy looking forward, talking about mergers and acquisitions, IPOs, the like. How much do you take a read from some of these earnings in terms of the forward look, if you can put aside the conflict in the Middle East, to get optimistic heading into the rest of 2026?
Lisa, it's critical in terms of what we're seeing with respect to consumer activity, particularly do we see credit change? And when I say credit change, are we seeing an extension of, again, we saw personal savings dip a bit, we saw personal income remain somewhat flattish, but are people extending credit in terms of financial services providers? And also, are we seeing consumers get a bit over their skis, if you will, with respect to putting too much on credit? Now, the data's been somewhat noisy, but in general stable, but that's somewhat backward dated. Again, most of the data we get from the Fed is about 2 or 3 months old. This is a great real-time indicator. When Jeremy Barnum and others talk about what they're seeing across their portfolios and their loan books, that's really important for our work. So making sure that we are seeing some stability with respect to consumer activity. Again, decent spending, but that spending can't just all go on credit because that credit, of course, has to be performing, as you and the team have done a great job of reporting for the last couple of months.
Eric, we spend so much time talking about the Federal Reserve. Just how relevant is the Federal Reserve to your outlook?
I think the biggest shock, if you will, Jonathan, to our glass half full perspective would be an outsized move higher in interest rates. That doesn't seem to be something, at least the front of the curve, we're not as concerned about that. We're more concerned about what some of your other guests have talked about in terms of what happens with budget deficits, what happens with the back end of the curve. We're in year 19 of the 10-year Treasury yield being below 5%. We've become accustomed, if anything, we've become incredibly desensitized to interest rate volatility. So the Fed, with respect to front of the curve, not really a big concern for us. We're more concerned about, was there upside risk, if you will, if, for example, the administration decides to get very aggressive with pro-growth policies that the bond market rejects. That would be more concerning to us than what the Fed may have to offer on a next couple of meetings basis.
Eric, it's good to see you. It's always good to catch up, sir. Thank you. Eric Freedman there of Northern Trust Wealth Management on the Federal Reserve. The front end of the curve there, you can see it on the screen, 380. Anchored around where Fed funds is right now at about 377, 380. This is a Fed that's not going to do anything anytime soon, as a market is well priced for it at the moment, at least on a 2-year yield. Looking at the situation in the Middle East, just how is the blockade holding up? Is it being tested? We were tracking one particular ship. What's the latest?
Yeah, this was a U.S. sanctioned tanker linked to China, and it seems that it has made a U-turn. So everyone was talking about the fact that this is going to be a huge test for the blockade. Does the blockade allow this sanctioned Chinese vessel through? And it looks like it's a no, and it U-turned, so not being able to make that journey out of the strait.
The potential for escalation avoided, at least for now. On top of what we've seen over the last week, Bramo, the market rally continues. You talked about it earlier. This market's moved on very quickly over the last week. The prospect of more talks encouraging this market to move on even quicker.
The fact that we had a blockade announced on Sunday or Saturday, and that Sunday night people came in, and I thought, wow, it's going to be a bloodbath. No, not at all. Actually, we ended the day higher yesterday. We're really close to where we were. We actually surpassed. We took out all the losses since the war began. Gives you a sense of where people's minds are at. This morning, just adding to that, the fact that there are reports that Iran doesn't want to escalate things. They're going to avoid trying to even have any ships U-turn to just avoid the conflict. And the fact, okay, U-turning, but at least there's nothing violent that's happening as a result of it. So people are looking at this and saying, next, earnings, let's hear it.
Minds are firmly on the future, on the summer. A touch of summer in the air in New York City into the 80s later. Spring with a splash of summer, right?
I'm actually very angry about this. I would like spring to be spring. I don't want it to be 85 and humid, but you're right. People are just looking to...
I'll take the 85 and humid.
I know.
And you're complaining about the aircon. Interesting. OK. Let's see how comfortable you are. Let's make it 85 and humid in the studio, and we'll see if you're happy with that.
No, but there's a happy medium. It doesn't need to be 64.
OK. We can continue having this back and forth. Just a moment. I look forward to it. All right. Coming up tomorrow, I really don't. Noel Dixon of State Street joins us, David George of Baird, Phil Camporelli of JPMorgan, and Pooja Sriram of Barclays. From New York City this morning, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.